Esteemed resource persons of this enlightening evening, my guru and Honorable Central Council Member of ICAI, say MP Vijay Kumar sir, and my good friend and past chairman of SIRC, say Jomon, my colleague in this regional council, say Sengal Reddy, participants of this evening program, very good evening to all of you. SIRC innumerable number of activities scheduled in this month on varied topics of professional interest. These programs vary from conventional to contemporary and futuristic subjects. It will cater to the needs of both the members in practice and in industry. And we have invited speakers from different parts of the country for the benefit of the members. On behalf of SIRC, I extend our warm welcome to our two of our eminent personalities in this profession, CA MP Vijay Kumar sir and CA Jomon to this program. We are thankful to both of them for coming forward to exchange their wealth of knowledge and wisdom with their articulated presentation on two important areas in accounting standards and Companies Act 2013, which has a closer linkage in respect of finalization, complaints, and presentation of financial reports. The first topic assumes importance as the financial reporting should be devoid of errors, as it provides insight into the company's health and the financial status with accuracy with the relevant data and assist in business decisions and present a transparent picture of the stakeholders. The gracious presence of MP Vijay Kumar sir, who is the chairman of Accounting Standards Board of ICAI, as a resource person would highlight the probable areas and circumstances when and where common and likely errors may occur in disclosure, leading to the compromising the quality of financial report, thus leading to the issue of financial reporting by the auditors. The session would therefore be very informative as to invoke our thoughts on these aspects while finalizing the financial reports of the various entities. The next session in the today's evening program is in Companies Act 2013, the key provisions on accounts and audit. Our past chairman, CA Jomon, seasoned speaker, with his in-depth knowledge on the subject of discussion, present an overall perspective of the key provisions on accounts and audit as contemplated under the Companies Act 2013. The participants would have the benefit of his exposure and expertise and help them to update their knowledge, as these provisions have far-reaching implications for our audit profession. I have great pleasure once again to offer my warm and hearty welcome to each one of you for this excellent program. With this, I request our regional council member, CA Sengal Reddy, to do a brief introduction about our speakers.
Thank you, Chairman sir. Chairman of SIRC ICAI, K. Jalapati sir, Honorable Central Council Member, Guru, Guide, Philosopher for so many members, CA MP Vijay Kumar sir, and past Chairman, my colleague in Regional Council, CA Jomon sir, under whom I undergone training and learned something towards the Regional Council. Two eminent resource persons today, my dear professional members, a warm and good evening to each one of you. It's my proud privilege to introduce our Guru, MP Vijay Kumar sir, who needs no introduction to the members especially, but I will give brief profile about the MPV sir. MPV sir, over 27 years of experience in industry and as a chartered accountant in practice, is a council member of ICAI from 2016 to 22, chairman of 2019 to 21 Accounting Standards Board, 2018 to 19 Valuation Standard Board, 2017 to 18 Digital Accounting and Assurance Standard Board. As a vice chairman, expert advisory committee for the 2019-21 Financial Review Reporting Board for the year 2018-19, and Committee on Accounting Standards for Local Bodies for the year 2017-18. He is a nominee member of so many committees, especially SAFA Committee on Accounting Standards for the year 2021, National Financial Reporting Authority for the year 1920, QRRB 2016-19, SEBI Committee on Disclosure and Accounting Standards 2016-19. He is a CFO of CP. He is a partner of Yoganandam and Ram Company LLP for from 1999 to 2007. Sorry. He is a resource person for professionals as accounting standards, IFRS, auditing standards, code of ethics, corporate law, governance, and capital markets. As a teacher, over 20 years of teaching subject of accounting, financial reporting, and corporate laws. He has awards of Capital Foundation Society, CFO, CMIA. These three are the awardees. Authored 10 popular titles with extensive readership and continuous reprint for over 15 years. ICDS, INDAS, Auditing and Assurance Standards. For students, he has authored 6 account books, which I need not tell about the books what he has authored. We are all read the books authored by our MPV sir. We passed our CA. Thank you, sir. Thank you very much. This is the brief profile of our MPV sir. And Jomon sir is a fellow member of the Institute of Chartered Accountants of India with 29 years of diversified practice of experience. Chairman of SIRC of ICAI for the year 2019-20, founder and managing partner of JVR Associates, and 8 partner firms specializing in corporate audits and consultancy. A faculty for auditing and at the Institute of Chartered Accountants of India has taught more than 10,000 CA students. Regular resource person on professional circuit on accounting and auditing standards and corporate audit. Has done more than 800 presentations, also a peer reviewer trainer, was a member of the Auditing and Assurance Standard Board of ICAI. He was chairman of ICAI Ernakulam for the year 2002-3, has traveled extensively in the UK, Middle East and Far East, past president of Rotary Cochin Central and member of various social clubs, Honorable Treasurer Kerala Management Association, member advisory board, SC Teresa College, Ernakulam. With this brief profile, I present both the speakers, MPV sir and my dear colleague, CA Jomon K. George, past chairman of SIRC of ICAI. Thank you, sir. Thank you, chairman. Sir, the screen is yours, sir. MPV sir.
Thank you, Chengal, for that detailed introduction, and thanks, Jala, for the invite. Happy to be part of one more event coordinated by you. Without much ado, I'll go straight into the subject. Is the screen visible to all?
Yes, sir. Yes, sir.
Yes, sir. Yes, sir.
Yes.
PowerPoint visible?
Yes, sir. Yes, sir.
Yes,
Visible,
sir.
sir.
Mode only, sir. Yeah.
Visible, sir.
Okay, fine. Let me arrange the screen for myself. Okay. So without coming to this topic of common non-compliances in accounting standards, within the institute we have, among the several committees or boards, one of the important boards for improvement of quality of financial reporting, which is the Financial Reporting Review Board. The board has now been there in existence for a little over a decade, and the focus of this board has been essentially towards helping improving the quality and less towards disciplinary process. So the idea is to identify common mistakes and advise the auditors concerned that these are areas for improvement. But if there are areas of gross negligence, we obviously refer them to the disciplinary committee. So what I will be presenting to all of you over the next 80 minutes or so is findings from the reviews which are done by the Financial Reporting Review Board. And the findings which I am going to share are all common non-compliances. Apart from this, there are non-compliances which are very entity specific. So common non-compliances would mean that you come across in multiple financial statements, you find these mistakes. And while I introduce, I want you to continuously keep in your mind two things. And then do an introspection of what more we need to do. I reiterate, as I speak over the next 80 minutes, keep in mind these two things consistently, so that we get to know how much more of journey we have to perform for improving the quality of financial reporting. Point number one is that all of what I will present to you are reviews which have been done for listed companies, large listed companies, and mostly by established audit firms. So every mistake which I'll be showing you are mistakes which have been done in the case of large listed companies and by fairly established audit firms. The second point I'd like you all to keep in mind is that what we are discussing is accounting standards, not Ind AS, And accounting standards, as you know, started its journey way back in 1977. And the major set of standards took final shape by year 2000, 2001. So we had approximately about 14, 15 standards till mid 90s. Post Companies Act amendment in 1998, a huge set of standards were introduced, and all of these standards, effectively 27 in number as we speak now, they have been there since 2000, 2001. So these are all common non-compliances which have been identified in the recent 6-7 years, which means the standards have been there right since 2000, 2001. Reasonable amount of competence has been built over a period of time, and still you have these errors which are happening. So keep these 2 points in mind. A small caveat before I go further: whatever views I share are my personal views as a professional. None of them should be seen as views of any of the committees of the institute I am part of or of the institute council. So greetings to all of you, and I trust each of you are safe and all your near and dear ones healthy. Very happy to share the platform once again with a very learned member, Jomon George, and thankful to Jalapati for the invite to be speaking on this topic today. So while I get to the topic, I'd just like to highlight one specific aspect. There are 3 golden rules which I have believed in right through my career. Since most of you would have heard me on this, I'll reiterate. I'll spend a minute on the third one. While the slide is visible to all of you, I'll spend a minute on the third one because it is so integral to our topic. I have been a strong believer that financial statements is a communication. Your balance sheet is a communication. Income statement is a communication. Cash flow statement, notes, all of them are a communication. So when you're preparing those statements, you're communicating about that particular entity. Similarly, the audit opinion which you express on financial statements is also a communication. Just like in personal life, you and I expect that every communication we receive whether we receive it from family members or from the staff at office or any other person we interact. We all expect that the communication we receive should be complete and truthful. The same is true when it comes to the communication which you make through financial statements and through the audit opinion. That communication which we make either as a preparer or as an auditor has to be truthful and complete. Truthful and complete. Now, I'll just give a little brief on how this process works so that you get confidence about these non-compliances, the way they have been identified, and what better learning than learning from mistakes, learning from one's own mistakes, learning from others' mistakes. So the FRRB review and the publication which is done is a publication which basically talks of mistakes which have been done. So when you know that these are the mistakes, you can avoid making those mistakes. So we actually have a 3-stage process of review. Stage 1, where each annual report is analyzed by a technical reviewer, a chartered accountant with reasonable experience. Stage 2, it is reviewed by a group of chartered accountants. Whatever the reviewer finds, then a group meets and reviews all the observations, and these group recommendations are then sent to the board. And at the board, my experience, I've been there for 5 out of 6 years. Each annual report on an average 2.5 to 3 hours is spent for reviewing the observations. We review observations given by the technical reviewer. We review observations given by the group. Then there are observations identified by the staff of the board. And then the observations which come through the deliberations. So it's a fairly involved process where approximately 2.5 to 3 hours is spent per annual report to find out the non-compliances, whether these non-compliances require reference to a disciplinary action or an advisory or to withdraw. And for this review process, given the present capacity, on an average about 80 annual reports a year are reviewed, and these are picked up through a process of random sampling. So about 76% of them are through that process, and there are about 24% of cases referred by authorities like SEBI, RBI, MCA, Election Commissioner, IRDA, they would refer. So a combination of these two cases are taken up, and between technical reviewers and the group, we have almost about 500 professionals who are involved in this entire process. And for these 500 professionals, there's a small honorarium which is also given, just to ensure that the reasonable expenses are met for the effort of research and other clerical efforts which they would put in. So this particular review which is done, we broadly identify them as 2 categories. One is those where there is no non-compliance, which is material or which does not affect the true and fair view of financial statements. So those kind of non-compliances, we issue an advisory to the audit firm and tell that these are 10 areas where you can improve, and copy of that is given to the peer review board. So the next time when the peer reviewer goes to the audit firm concerned, he can see whether the quality improvements have been done. Second category is material non-compliances, which affect the true and fair view of financial statements. As far as true and fair view is concerned, I would like to highlight here, many have an impression that true and fair view would mean if the profit is not reported correctly. Not necessarily so. Balance sheet classification, if it is not shown properly, also affects true and fair view. Disclosures, if they are not made properly, also affects true and fair view. If you can connect to your SA 700, Audit Standard 700, before you give an unmodified opinion, reasonable assurance, unmodified opinion, the auditor needs to satisfy himself or herself about the true and fair view of the financial statements, which includes recognition, measurement, presentation, and disclosures as well. I'm highlighting this because many have this impression that true and fair view means profit getting impacted, then probably I should be careful, but need not necessarily be. If you wrongly classified something which is current as non-current, that is also affecting a true and fair view. Similarly, if there are some disclosures which you had to give, like components of deferred tax, if you have omitted to make those disclosures, that can also affect a true and fair view of financial statements. So if it affects true and fair view, then we refer it to the disciplinary directorate for action against the auditor after due process. And we also parallelly inform MCA, and if it is a listed company, SEBI, for further action to be taken on the company concerned. The reason is institute does not have jurisdiction on the preparer, so we refer it to the authority concerned for taking action. So over a period of time, the board has been there for close to 12 years now. On an average, about 80 annual reports a year is what is done, and generally it is 76 to 3/4, 1/4 ratio of cases identified by a random process and cases referred by various authorities. So till the end of last year, of the 956 reports reviewed, 160 have been referred to disciplinary committee for action. 154 have gone to regulators like SEBI, IRDA, MCA for action. 35 have gone to Election Commission of India, and about 599 cases of advisory. So these are publications of the FRRB, and I would strongly encourage particularly practicing members that these publications may please be read and made part of the staff training process so that the quality of financial reporting keeps improving. And all along, the financial reporting reviews were all around accounting standards. The previous year we had issued in the context of Ind AS, a small publication because we could do only limited number of cases, but that's available for Ind AS. Now, the non-compliances are spread across all of the standards. There are some standards where you will find the extent of non-compliance very, very high. For example, standard on cash flow, retirement benefits, employee benefits, deferred tax. These are standard, and even intangible assets, where you'd find very high level of non-compliances. Apart from that, there are non-compliances with reference to audit standards, CARO and all. Today's discussion, we are confining ourselves with accounting standards. Now, so as far as the Non-compliance concern, I'll walk you through standard by standard. Interest of time, I may not be able to walk you through all of the cases which are in this document, but I will leave a copy of the slide deck with Jalapati, and I'm sure there's a way to reach out to all of you. So I will spend time on some of the issues, but you will get a sense of the nature of mistakes which are happening. And for some of you, when you listen me, particularly the next 10-15 minutes, you will feel that, do these mistakes actually happen? It looks so trivial. Does somebody actually make these mistakes? That's the impression you would get when I introduce to you these mistakes. But very unfortunately, as I told you, these are all large listed companies, and there is well established audit firms where these mistakes have all been identified, and in respect of standards which have been in existence for a very, very long time. For example, a standard like AS2 in existence for whatever long period, and still you have mistakes happening on those standards. Now, what I will also do as I go through is that on two standards, to the extent of time available, I would like to give a little bit of a conceptual introduction. One is on AS15, employee benefits. Another is on AS22, taxes on income, because these are two standards where the extent of mistakes are very high. And my personal view is that these mistakes are largely because of limited understanding of those standards. I don't think people are making mistake by design. I don't want to attribute a malified intent there. Of course, deferred tax is vulnerable for such malified actions. But the way I see these annual reports, the quality, it appears to be largely out of lesser understanding. So I'll try to spend a little time on those. Now, let's take this accounting standard 1, disclosure of accounting policies. And please recall, I'm sorry to repeat so many times, these are all live cases, listed companies. So this is a case of a company which says unrealized loss on outstanding derivative contracts has not been recognized in books, considering principles of prudence enunciated in AS1. So loss not recognized because of prudence. Now, all of us are aware, prudence, if at all, requires you to recognize the loss and not to recognize future expected profits. So this is a clear case of violation. Second, this is a case of a company where the subsidies which are given by the government are recognized in the income statement in accordance with the relevant terms and conditions of the scheme. So as far as AS1 and AS12 read together, as far as grant is concerned, there is clear guidance on when to recognize grant, how to recognize the grant. So this accounting policy, what you see in the first two lines, is not appropriate. You need to communicate when do you actually recognize the grant. So what conditions you fulfill when you get certainty of amount and certainty of collection, wherein you recognize the grant, that should be specifically mentioned. This is an accounting standard relating to, again, revenue recognition, accounting policy, where the entity says, which is the electricity company. Electricity companies, as you know, are fairly large companies, very large entities. It says that revenue is recognized on the basis of tariff orders notified by the appropriate authorities, and where the orders are pending notification, the income is accounted on provisional basis as per tariff norms. So this again does not fall in sync with the requirements of AS 9 on revenue recognition, where it has to be very clear with reference to no uncertainty of amount, no uncertainty of ultimate collection. Both of those are extremely important. Now, there are many companies where they would have transactions relating to employee benefits, taxes, they would have impairment, they would have inventory in their books, but accounting policies would not be there. So the standard very clearly requires that for every item which is material and which you have in your financial statements, you need to disclose what is the accounting policy. Before I go to inventory, I just have one general word of advice on accounting policies. Again, based on experience of reading the annual reports in FRRB, QRB, and research committee. Almost 800 to 900 annual reports I've gone through. My strong recommendation is on accounting policies. Please do not attempt to draft in your own language or sentence construction. Please do not hesitate to borrow the language which is there in the standard itself. So when it comes to accounting policies, to the extent possible, please try to borrow the words in the standard as it is. Some people feel a little shy that why should I copy from standard? I would like to explain on my own. But when you try to explain on the own, more often than not, the meaning changes. I'll just give you one small example, maybe related to inventory. When it comes to valuation of inventory, the requirement is valuation of inventory at lower cost and net realizable value. Many occasions, people write lower of cost or NRV. The word or there completely changes the meaning, of the accounting policy. So the word and is a critical word, and when standards are drafted, every word, every punctuation mark is debated and every word has a meaning. So it has to necessarily be the word and. So it's a very simple example I'm giving, but it's true across all standards. So my request is, in the interest of the overall quality of the profession, which is when the stature of the profession will go up, let's make efforts to ensure that for every client, small or big, the language of accounting policy is, to the extent possible, same as it is in the accounting standard. Tweak it only if it is super essential. Now, let's come to accounting standard 2. So here is the case of the accounting policies, the way they have been disclosed. Look at the list at the bottom. And I just gave you an example of drafting an accounting policy. So someone says stock of cards are valued at cost and on FIFO basis. Work in progress is valued at direct raw material cost. Someone says average cost. Another says work in progress at value at raw material cost. And cost of finished goods and WIP is on estimated cost basis. All of us know that inventory is one number at the end of the year. The ethics with which you value the inventory has an impact on the profit or loss of that reporting period. So when you look at language like this in accounting policy, like on estimated cost basis, so none of these are there anywhere in the standard. So languages like this are prone to mischief, So all of this drafting can lead to serious action. Institute over time has been more around enabling quality improvement, but probably time has come where we have to tell people that any quality deviation, punishments have to be given. Punishments have to be serious enough to improve the quality. And mind you, as I told you earlier, all these are for listed companies. Then leave aside so many public sector, unlisted, private limited companies and all which are there. So this is the state for listed companies. And many have not stated that inventory is lower of cost in NRV. So all of these have not been considered. Now, with reference to excise duty, we are all aware that pre-GST days and now in the context of GST, as far as the excise duty is concerned, for the purpose of inventory valuation, the moment production is complete, the excise duty expense should be recognized and unsold inventory should include the cost or include the excise duty element. So by removing excise duty in the inventory and in expense, the profit figure does not change, but the inventory value would not be appropriate number, nor does it show properly the excise duty obligation which has arisen. Payment is on clearance of goods, that's a different subject, but the law recognizes that the moment production is done, the liability has arisen. So many entities we come across this gap where excise duty is not considered in inventory valuation. Then look at these disclosures. Inventories are stated, look at the bottom part, stated at lower of cost in NRV. Cost is determined on weighted average / FIFO as considered appropriate. There is another company which says is computed on weighted average / FIFO. So this kind of accounting policies are not acceptable. You have different categories of inventory. You need to very clearly tell that inventory is lower of cost and NRV, and the method of ascertaining cost for these items of inventory is FIFO. For these items, it is weighted average. That should be pretty clear. Now, coming to non-compliances relating to accounting standard 3. So here is the case of annual report of a bank, and bank, you know, size is large, most cases joint auditors and a lot of public interest. So in these cases, again, the investments which are there, when you have investments which are you are held for trading investments, those investments should come as part of your cash flow from operating activities and not as part of your investment activity, not as part of investing activity. So the moment it is investments, people have a tendency of taking it directly to investing activity. But in the context of banks and financial enterprises who regularly deal in investments, such dealing in investments, they would be treated as their operating activity. Then, in this accounting standard 3, we also have a requirement that if you have investments which you are making in subsidiaries, associate, joint venture, those investments, whether it's a purchase or a sale, you should not combine it with total investments purchased, total investments sold. The standard is a specific requirement that investments purchased in subsidiaries or association or joint ventures should be shown separately from the other investments. So that's a specific disclosure requirement which we have. Another very, very common mistake we come across is most organizations, almost all organizations have exchange differences in their P&L. Exchange differences, as all of us know, can be realized exchange difference or unrealized. So if you have receivables, payables, loans in the balance sheet, forex receivables, forex payables, loans in balance sheet, then unrealized exchange gains and losses are part of your P&L. So when you prepare your cash flow from operating activity and you start with your profit before tax, you have to necessarily adjust for the unrealized gains or losses. But most cases, a large number of cases, people miss out on that particular adjustment. They miss out on that adjustment. They just start with profit before tax and move on. Consequently, the cash flow from operating activity figure becomes a wrong figure. That's one common mistake we come across. And there are many organizations who have branches abroad, foreign operations abroad, or they have subsidiaries abroad and for consolidation. So when you have this cash in foreign currency and you translate it, so I have a branch operation and there is a cash of $10,000, $30,000 you're carrying, and there's an exchange difference on that cash. That exchange difference should not come anywhere in cash flow statement. It should come only as part of your reconciliation of cash and cash equivalents. Then this is another very common mistake which happens. Non-financial enterprises, that is manufacturing companies, trading companies, service companies, that is companies other than banks, companies other than financial enterprises. Very common mistake is finance income, finance expense netted off. Expense 5 crores, income 1 crore, net 4 crores. Tendency, P&L, they show it like that and give us some schedule or notes. The same thing they carry into cash flow statement, because cash flow statement is spreadsheet, formula, picked and all. So in cash flow statement also they show the interest expense net item. But standard requires very clearly, interest income should come as part of investing activity. Interest expense should come separately as part of financing activity. So that is another common mistake which you come across. Recall I told you, there are 3 standards where mistakes are maximum: employee benefits, cash flow, deferred tax. Of course, others also there are a few mistakes. Now, here a case where dividend tax. So as far as dividend tax is concerned, here is a case where the company showed dividend tax along with the normal tax, in the operating activity. But the standard requires that wherever tax can be identified with a particular cash flow, the tax should be shown only as part of that activity. So when it comes to dividend tax, of course, not relevant now, maybe up to 2 years back or until the law changed. The dividend tax should be shown only as part of financing activity along with the dividend outflow. Then cash and cash equivalents. This is another common error. And these are errors which can be avoided with minimum effort. There are many who have this impression that cash and cash equivalents in balance sheet is 7 crores. So cash and cash equivalents for cash flow statement should also be 7 crores. It doesn't work like that. Because their schedule 3, it has a different structure where there are many amounts of cash which are earmarked cash balances and all. Whereas here the cash flow balance required is different. So these 2 cash balances most likely will not be the same in majority of organizations, because some cash balances there will be a lien, some cash will be unpaid dividend amounts, so on and so forth. All of that should be eliminated as part of the reconciliation. Then, with reference to non-financial enterprises, that is manufacturing companies, etc. and all, the loans which are given, usually loans given to group companies, etc. and all, they should not be shown as part of operating activity. They will all come only as part of your investing activity, and presentation should be done on a gross basis. Then, as far as the fixed assets are concerned, here is one case where in the cash flow statement, investing activities, one of the line items is fixed assets lost due to robbery. Lost due to robbery. This is the non-cash transaction. So typically these mistakes, the way it will happen is the article student is using the spreadsheet prepared by his or her senior 1 or 2 years back. So from the trial balance, there are schedules, sub-schedules, main statements, and then you have cash flow statement. Formulas are all linked. When it doesn't tally, somebody inserts this line and says this, the difference is identified, and you plug it there. Whereas it's a non-cash item which should have been adjusted as part of your operating activity cash flow. So these kind of mistakes do happen. Then similarly in cash flow statement, the standard requires starting with net profit before tax and adjusting for all non-cash items. One item we will always find in every annual report is provision for doubtful debts. That provision for doubtful debt should be added back, and only then you should find out your cash flow before working capital changes, etc. Even if you don't add back and take debtors on net basis, cash flow from operating activity will tally, but the line items in between will be erroneous. So it's important that the provision for doubtful debts should be added back while arriving at your cash flow from operating activity. Then I'll just focus on some material ones given the overall interest of time. Accounting standard 4. Look at this first two lines. And sorry for reminding again and again, large listed companies, established audit firms, just keep that in mind. And standard like AS4 has been there for 40 years. So someone writes events occur after balance sheet but before finalization of accounts. Finalization of accounts is more a colloquial expression. As all of us know, for accounting standards purpose, it is up to the date of approval of financial statements by the board of directors. So it is not finalization of accounts, it is that. So there is a importance attached to that expression. So this is one other common mistake we come across. Accounting standard 7, and here also reasonably good number of mistakes we come across. Look at the first two lines. Accounting policy of a company which is in construction business, where it says revenue is recognized on the basis of running bills approved by clients, and revenue expenditure is accounted on accrual as and when it is incurred. So as all of us know, accounting standard 7. So revenue to be recognized only on percentage of completion method, nothing to do with the running bills. And expenditure to be accounted to the extent of work completed. Rest of it will be carried separately as inventory. So that has nothing to do with the determination of profit of that year. Now, this is another entity. which has construction activity, but in the balance sheet and disclosures, A7 requires disclosures relating to advances received, retention money, etc. All those disclosures are missing. Accounting Standard 9 on revenue recognition. Here is the case of a company. Read the second para, 1.5 lines, second para. Revenue from sale of tickets is recognized when tickets have been sold, and advertisement revenue is recognized when advertisement and net realization is confirmed. So effectively, it is recognition of revenue on receipt basis. But as all of us know, revenue is to be recognized here only when the service is rendered, only when service is rendered. If it is tickets, show, advertisement, the advertisement having been done. And I'll just spend a minute here on revenue for services. Very common mistake, and hence I'll take this little time. As far as services are concerned, the standard talks of two methods. One is completed service method. Second is proportion of completion method. There is a general impression that any of the methods can be followed, which is not correct. The standard provides that if the service involves a single act, revenue should be recognized only on completed service method. If revenue involves multiple acts, multiple activities, then you need to recognize on proportionate completion method. So it is not a choice of this method or that method. It is to be chosen based on whether the service is a single act or multiple acts. Now, then educational services, and this is for online. And just imagine in online where there are so much of valuations which are happening, and listed company, just imagine listed company and lot of valuation for online companies. Revenue is recognized on receipt of subscription fee, whereas revenue should be recognized as you deliver your education service. It should be recognized over the period in which you deliver. Imagine the amount of skew and the error in reporting. This is again a very, very common mistake we come across. Insurance claims, loss of stock, etc. Many write an accounting policy where they say insurance claim is the revenue and all. Insurance claim which you receive is not revenue. It is not covered by AS9. It is not covered under the scope of AS9 at all. So we should never equate it with revenue. And insurance claims, the recognition of the same should happen only when it is virtually certain, for which guidance is available in AS29. So it is contingent upon your claim being accepted, only then you can recognize. So it is first important point is it is not revenue. So common mistake what people tell is it comes as part of the revenue related accounting policies. This is another common mistake. Dividend is accounted as and when received. The standard requires or recognizes that dividend should be accounted when the receipt is established, the right to receive is established. In practice, for most of us, both mean the same thing, but in practice there are many cases we come across where I am a parent company, I have a subsidiary has declared the dividend on 27th March. So my right to receive dividend has got established. I have to recognize the dividend income, even though receipt may come on 3rd April, 4th April. So there are these kind of instances which are there. So standard requires use of this language called right to receive dividend. That's the expression to be followed. Then, as far as the revenue is concerned, these are all other common mistakes. AS 11. So when it comes to AS 11, common mistakes are regarding accounting policy drafting, where exchange gain or loss. Here is a case where the exchange gain or loss they carry in the balance sheet, but there is no accounting policy which has been disclosed. So it should have ideally come. Then here is the case where a company have recorded export sales at rate notified by customs for invoice purposes. Whereas the accounting standard requires that translation should be done based on the exchange rate prevailing on the date of transaction. So that should be the policy. So this one other common mistake which happens. There are many annual reports where they have non-monetary items. I have a branch abroad where there is fixed assets, etc., and you have to translate them. So those translation related accounting policies, they tend to miss out. And then you have gaps again surrounding disclosures. Accounting standard 15, I'll spend a little bit of time. In the interest of the overall value of the session, remaining slides, even if I don't complete, I'll leave a copy of the deck with you. You now have an idea of how these slides have been constructed, so you should be able to connect. So I'll spend about 10 minutes or so on AS 15, 10 minutes or so on AS 15. And one part of AS 15, which is post-employee benefits, the reason is majority of non-compliances, whether it's FRRB, QRB, or the research committee, where we do the best presented accounts, the mistakes come in this area. So I'll take this opportunity to see if I can add some conceptual clarity so that there can be an improvement in compliance with the requirements of AS 15. I know the standard actually is a little intimidating. I want to very honestly confess. It's a 148 paragraph standard, huge standard. It is the most voluminous of all the standards which we have in AS framework. Now, as far as AS 15 is concerned, while it is voluminous, I just want to give you the assurance that it is voluminous because of the extent of guidance it tries to give, but the standard is a very, very small, simple standard. It's a very, very small, simple standard, much smaller than many of the other standards you generally are familiar with. So AS 15 talks about broadly 4 categories of employee benefits: short-term employee benefits, salaries and all. So when it comes to salaries, accounting is very simple. All of us account it correctly, no mistakes. So as far as salaries are concerned, account it on accrual basis, expense, liability, payoff. Simple, no issues. Fourth category, the fourth category in the chart, terminal benefits. Whenever there is a retrenchment of people, voluntary retirement schemes of people, so those cases, as an organization have announced a VRS plan, employees have accepted it, I may do payment after some time. So the moment obligation arises, the moment you have announced a plan and people have participated in the plan, your obligation has started. You should recognize expense, create liability, pay it whenever. That is terminal benefits. So first and fourth is only so much. Long-term employee benefits. In most of the new generation organizations, they're very common, and I expect these to become more common in future. Sabbatical leave. Somebody works with me for 5 years, 2 years he can take a leave, do his business school program and come. Works with me for 15 years, take 3 years break, do a PhD and then come back, whatever. So all these kind of things will be common. So during that 2 years break, the 2 years sabbatical leave I have given, I pay salary. That salary cost, I am bearing it because person has worked with me for 5 years. So the salary I pay in the 6th and 7th year is not expense of 6th and 7th year, but expense of the first 5 years. Because somebody works with me for 5 years, he is getting the 2 years of paid leave. So that 2 years salary, I should recognize as expense during this period, because as an organization, I have received the benefit during this 5-year period, not in 6th and 7th year. So matching concept, that 2 year salary cost, I have to estimate and provide it here. That is on long-term employee benefits. How to estimate time value of money, etc. All those principles, the standard says borrow from the post-employee benefits. So we'll spend time only on post-employee benefits. So short-term employee benefits, terminal employee benefits, very simple accounting. With or without standard, we are likely to do the same. Long-term employee benefits, most likely will miss our attention. So standard says, look, you have agreed to give the 2 years break because he's worked for 5 years. So that 2 years cost, you include and amortize it here. That's on long term. So let's come to post-employee benefits. As far as post-employee benefits are concerned, these are benefits other than termination benefits. That is the VRS, retrenchment and all. Other than termination benefits, which are payable after the completion of the employment. And these termination benefits, or these post-employee benefits include pension, medical assistance after retirement. They include gratuity, provident fund, etc. Most of us are familiar with provident fund and gratuity. But if you look at public sector organizations, after you retire, free medical assistance for the rest of your life for you and family. Post retirement, you would be eligible for pension up to whatever period. So those are all kinds of post employee benefits which are there. So if somebody has worked between the age of 20 to 60 for 40 years, and he is going to get some money from 61st year up to his death, that cost organization incurs because the organization has derived benefit during this 40-year period. So when the employee is working for you between the age of 20 to 60, during that period, this cost has to be recognized and amortized. So in the context of these post-employee benefits, most popular and what you and I come across, all private enterprises, private sector enterprises, provident fund, gratuity fund. So provident fund, most organizations, there's a specified percentage of contribution you pay it to government month on month. Employee 12%, employer 12% contribute to government, it's done. As far as gratuity is concerned, by operation of law, every employee who completes 5 years of service is eligible for an amount, 15 days pay for each year of blah, 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 all that stuff. Now, so when it comes to Provident Fund, you know how much is the amount to be paid, you contribute and you're done. But as far as gratuity is concerned, there's a 20-year-old kid who has joined my organization. I don't know whether he will leave me when he's 27, when he's 37 or he's 57. I don't know when he will quit the job. And I don't know what is his last drawn salary. So I need to make an estimate of how much benefit is likely to get and account for the benefit over that particular period. So broadly, two categories of post-employment benefits. One is benefits where you contribute an amount, after that nothing else, you're chill. Second is you have to give this benefit. You don't know how much you have to give, when you have to give, so you have to estimate and make a provision. So one category of plans are called defined contribution plans. Other category of plans are called defined benefit plans. Popular example of contribution plan is Provident Fund, and for benefit plan it is gratuity. But please note, Provident Fund can also be a defined benefit plan. For example, time permitting, look at Infosys annual report. So Infosys has their own Provident Fund approved by the government. They manage on their own and they guarantee a particular return. So those cases, if employer takes responsibility of guaranteeing a benefit, then it becomes a defined benefit plan. So as a thumb rule, Provident Fund is a contribution plan, but as an exception, it can be a benefit plan. As a thumb rule, pension is a benefit plan based on last drawn salary, but pension can also be a contribution plan where amount of pension is directly based on how much contribution you have done. So you cannot come to a straight jacketed conclusion that PF means contribution, pension means benefit plan. No. Generally, yes, but there can be exceptions. You need to watch out. Now, as far as these benefit plans are concerned, post-employment plans are concerned, since the amount is paid after 7 years, 20 years, 30 years, 40 years, you will not get that cash all of a sudden. So you have to accumulate cash over a period of time. For that accumulation process, there are different ways of managing that cash flow to meet the liability. One is give it to government, let them manage it. They are called state plans. Second is 5-6 employers come together, constitute one trust, one fund, and they manage it. They are called multi-employer plans. Third, I hand over some money to insurance company, they will manage it. They have experience of managing investments and all, let them manage it. Fourth is, I am a group of companies, myself, 3 subsidiaries, 4 associates, 2 joint ventures, we all do it. Group administered schemes. In day-to-day life, for most of us, Provident Fund is a state plan, gratuity is an insurance plan. Reason is, by law, Gratuity Act section 4A requires compulsory insurance with LIC. If you don't want insurance, then you have to get approval of commissioner, etc., all that stuff. So contribution plans, Provident Fund is generally a state administered plan. You contribute to PF commissioner. With that, your life is done, simple. Gratuity plans, most cases, you receive a quotation from insurance company, premium amount, you pay it. Now, These are broadly the 4 kinds of administration of the plans. So I talked about contribution plan, benefit plan, all of it I have talked about. As far as accounting for contribution plans is concerned, it is the simplest. Provident fund contribution is the simplest, where every month or for the year, your 12% share, expense debit, liability credit, whatever liability you pay PF commissioner, that unpaid amount will appear in your balance sheet. Typically, since we pay it within 15 days, as a thumb rule, 31st March every year, your March contribution is what will appear as unpaid amount. In the case of contribution plans, important is no question of any actuarial assumptions and all. No question of any discounting. I want to highlight one very common mistake here is that accounting standard 15 requires that in your P&L notes schedule, when you show salaries and wages, contribution to PF has to be shown separately. Many people make a mistake of contribution to PF, gratuity, whatever. That is not allowed. Contribution made to a defined contribution plan should be shown as a separate disclosure. That's a legal requirement. That's a requirement of the standard. Now coming to defined benefit plans. Now defined benefit plans require this concept of actuarial valuation. Let me walk you through with an example. Before I take you through this example, this one particular slide to understand components of post-employee benefits. I'll go a little slowly. Doesn't matter if I'm not covering the remaining slides. If time is inadequate, I'll stop after this. But this portion, I'll go very slowly. And if I've been able to ensure AS 15 better compliance, I would consider this 90 minutes to be well spent. Now, as far as the post-employee benefits are concerned, think of gratuity. Think of gratuity. The amount to be charged to P&L. Many have this impression that the premium paid to insurance company is the expense for P&L. That is wrong. That is wrong. Amount paid to insurance company is funding the gratuity liability. It is funding the gratuity liability. It is not the expense. So expense can be 10 lakhs. Premium can be 9,50,000. So 50,000 unfunded liability. Some cases, expense 10 lakhs, premium 10,20,000, advance premium paid, insurance asset. Some cases it can happen. So important is insurance premium is not equal to expense in income statement. It is a cash flow. Now, for the income statement, we essentially have 4 plus 1 plus 1. What will go as expense in your P&L for gratuity will be 4 plus 1 plus 1. This additional 2 items may come, may not come. They are all exceptions. But these 4 will always come. 4 together is the expense for P&L. All the 4 together is the amount to be debited to your P&L. What are these 4 items? Now, these 4 items are, I'll give a very simple example. Let's assume my salary is 20,000 per month, 20,000 per month. And I am expected to retire 10 years from now. The likely salary when I retire 10 years from now, let's assume is 30,000 per month. So 15 days salary, half month salary, simplistic sake. Let's not break our head 15 by 26 and all. half month salary, let's say 15,000. So the amount I have to pay end of 10th year, 15,000 per year for 10 years, 15 into 10. So let's say annual salary, let's say we're talking about 15 days salary per year. So now this much into 10. Now this 15,000, year 1 15, year 2 15, year 3 15, it keeps on accumulating, becomes 1,50,000 and I pay at that time. But all of us here know the 15,000 rupees which I have to pay in the end of 10th year is not the same today. In terms of time value, the present value of 15,000, the present value of 15,000 is only 9,400. So this 9,400, every year interest will accumulate and become 15,000 and will get paid. This 9,400 is called current service cost. When I come to second year again there's a present value of that 15,000 plus previous year 9,400 is moving one time zone close. Previous year 9,400 is going one time zone close. So there's an interest getting added. So for second year P&L, the expense will comprise the current service cost of second year plus interest on the opening liability. Whatever opening liability, it is going one time zone closer. So that interest has to get added. That is the second element. Third, we'll go back to our schooling days, college days, sinking fund method. If you recall sinking fund method, what do? We create a liability, we invest. We create a liability, we invest. And if you recall that sinking fund table, to get 1 rupee at the end of 10th year with interest at the rate of 6%, every year you have to invest 0.83421 some number. So you have that. So which means for getting 1 rupee 10 years from now, this much money you should invest. And you are assuming interest to be 6%. But actual return can be 5.5%. It can be 6.3%. So every year you are receiving interest on whatever investments you have made, plan assets. So whatever plan assets I have, every year I'm earning 6% because I created this liability assuming I will earn 6% during this period. Every year 9,400 I'm holding back cash and investing also. So this investment is giving me a return. That expected return will go to reduce my expense. So third element is interest income on your plan assets. So year number 2 for P&L it is current service cost plus interest on the previous year amount minus income on your plan assets. The fourth element is what we call actuarial gains and losses. These gains or losses come because of two reasons. One, recall again sinking fund, liability asset. Asset side, I thought this asset will earn 6%, but now change in market value, etc., yields have gone up, come down, value has changed, gain or loss. Similarly, on liability, in an organization, there are thousands of employees and you are expecting people to work for so many years. But some assumptions keep changing every year. As the assumptions change, assumptions can change regarding salary growth rate, longevity of employment, attrition rates, etc. All these will keep changing your liability. So as your liability keeps going up and down, that fair value changes are called actuarial gains or losses. So these four items together will be equal to your expense in P&L every year. Apart from this, we have what is called past service cost. Past service cost means gratuity. Earlier it was up to 10 lakh ceiling, now increased to 20 lakhs. So when the liability has gone up, that benefit is available to all the employees for the past period also. So there's a sudden increase in liability for people's contribution in the past period. Some employees have already completed 5 years and they're eligible for higher amount if they leave today. Some employees have worked only 2 years. They have to work 3 more years before they're eligible. So whenever there's a change in your plan, whenever there's a change in plan benefits, some plan benefits will immediately belong to employees. It is called vested benefits. Immediately belong to them. They are eligible. I finished 5 years. If I put my paper down, I'll get. Some employees, they have to wait 3 more years. That is called unvested benefits. So what AS15 says is, whenever there is a change in plan benefits, cost associated with past period, if it is vesting immediately, recognized as expense now. If it is vesting another 3-year period, amortize over the 3-year period, straight line basis. Last is, so that is the 5th element of cost, but it rarely comes. Last is any curtailment of plan benefits reduced, etc. That cost is to be adjusted. So let me take one live example for understanding this. So this is about 3-4 slides. And I would encourage, I'll go very slowly. I would encourage that when I come to 3rd slide onwards, I would like you to preempt me in terms of what you would do. I would like you to preempt. Slide number 1, illustration. 1st April 2006. Let's assume, think of sinking fund. There's a plan liability 1000, assets also 1000. Fortunately, it is matching 1000. Opening liability 1000, created in the past, assets also 1000. 2nd year 2007, there's a change in the plan. Employees are eligible for additional benefits. Some of it is vested, some of it is unvested. Recall, I just told you, vested means I should recognize expense immediately. Non-vested over a period. Let's, in this case, over a 3-year period. Now, second slide of the illustration, which is regarding facts. This is facts. Next slide onwards is calculation, and I want you to preempt me. Next slide onwards, I want you to preempt me. Discount, we'll focus only on 1 year. 2nd and 3rd year, you can spend time later. And please note, this illustration is not my discovery. It is there in AS15. I've just done a bit of structured presentation and coloring. That's all. My value addition is only that much. So discount rate 10%. Expected return on plan assets. Recall example I gave you 6%. Like that, here it is 12%. Current service cost 130. Recall the example I gave 9,400. What I have to pay 10 years later? Today's current service 130. 150 benefits paid. Some employees have retired, I pay them off. Liability will get reduced, I'll pay them off. Contributions paid means your insurance premium. This contribution paid is equal to insurance premium, what we commonly know in our mind. Present value of planned liability end of 31st March. Fair value of plan assets end of 31st March. And let's focus only on 2006-7. Other 2 years you handle later, 6-7. Now, how does this whole thing work? It works as simple as what you can see here. Just again think of sinking fund, plan liability, plan assets. Opening plan liability is 1000. Created in the past is 1000. You are moving one time zone closer now. Liability, you're moving one time zone closer. So interest, expense debit, liability credit. Interest 10% on 1000, expense debit, liability credit. And please note, I'm spending all this time because in your audit working papers, as an auditor, you should have verified all these numbers and correlated the journal entries. Only then your audit working paper is complete. So this 100 rupees, expense debit, liability credit. Current service cost, expense debit, liability credit. So for this current year, my current service cost, expense debit, liability credit. Recall, I told you expense 4 items are there. Current service cost, interest on opening obligation, those 2 items. Then benefits paid. Employees have left the job, 150 I have to pay. Liability debit, cash credit. Liability debit, cash credit. From plan assets, I will pay off. So my liability has now come down to 1080. 1000 plus 100. All these are journal entries, mind you. 100, 130 minus 150 is 1080. Actuarial valuation, liability is 1141. As per books, liability is 1080, but actuary, projected unit credit method, he tells me that your liability is 1141 according to revised salary growth rate, attrition rate. He tells me it is 1141. So in books, liability is only 1080. So there's an extra liability of 61, which is the balancing figure. Extra liability means expense, cost, expense cost. So in your mind, total expense for P&L 100 plus 130 plus 61. Now plan assets 1000. On plan assets, my return, like that 6% here, it's 12%, 120. So return is I'll earn an income. So income credit, plan assets goes up. Income credit, plan assets goes up, debit. So which means the income, recall, I told you 4 items, the income we will reduce by determining the expense. Then contributions which are received. So 90 rupees fresh contribution received. So plan assets debit, cash credit. So cash, I am moving it to my plan assets, investments, whatever I have moved it. And 150 rupees I have paid off during the year. People have left the job. So my plan assets figure is 1060. 1000 plus 120 plus 90 minus 1060. Market value of plan assets is 1092. So which means I have a gain. My assets are market value is higher. So 30 rupee, 2 rupees is called actuarial gain, balancing figure. So actuarial gain 32 balance figure, and liability side loss is 61. So net actuarial loss 61 minus gain of 32. My actuarial loss is 29. Now, before I come to the last slide on this, I'll be extremely happy, and more than that, you will be happy if you can, in your mind, looking at 2006-7, find out how much is the expense for P&L of 2006-2007. Expense is, I will give the line items, you figure out the numbers. Expense is current service cost, interest on opening liability, interest income on plan assets, net actuarial gain or loss, 4 figures. So the 4 figures are 130 expense debit liability credit, 100 expense debit liability credit, then income credit, which means your expense comes down, brackets 120, and plan assets will increase, and actuarial gains or loss, net figure of 29, entries will come, net 29 this figure. So these four together is what will go to your P&L. So look at the middle portion to P&L 139. 139 will go to P&L. And in your notes to accounts, you have to give the breakup of this notes to accounts. And out of 139 debit P&L, liability credit, 90 rupees we have paid in this current year. Balance 49 unfunded will appear in your balance sheet. This is how the whole accounting works. And all of this needs to be shown in the notes to accounts, etc. So this is about post-employment benefits. So lots of disclosure requirements here. I'm not sure if I've crossed the time. I think I'm almost close at 7:30. So I'll leave these slides behind. But if I've been able to give you a sense of the common mistakes and you can connect with the slides, and AS 15, if I've been able to help the cause of improved accounting. AS 15 is a thumb rule, very common mistake people do. Insurance premium, they debit P&L and say I've accounted for gratuity. That is wrong. That is wrong and is subject to disciplinary action. So it should not be the case. You have to go through this whole structure. As an auditor, these working papers I should have reviewed fully, and there's a huge list of disclosures in para 120. Typically AS 15 notes to accounts will take minimum 2 pages or 3 pages. So that much disclosure should be there. If that is not there, which means AS 15 compliance isn't there. So with this, I will conclude. I don't want to eat into Jomon's time and deny you the benefit of listening to him. Let me just conclude with one observation. Again, of this former president or the founder president of our institute, a person whom I adore a lot, Shri G.P. Kapadia. I'll just read from his second half of the quote. Technical excellence in performance of functions and observance of highest in professional ethics constitutes the foundation on which its future can be built. My own personal view, whatever professional work we do, when there is technical excellence, compromise on ethics will be almost zero or zero. And for the profession, we all want stature, we all want respect. The profession stature is directly proportionate to the weakest link in the chain, We are as strong as the weakest link in the chain. And it is our responsibility to ensure that every financial communication, recall balance sheet audit opinion, everyone, including the weakest person, has to be good. Only then we can say the profession is doing good. We can't keep saying 99% of us are doing job, 95% are doing job. There aren't listeners for that. Just like medical profession, when you and I experience, we expect 100% accuracy. Any product or service we receive, we expect 100% accuracy. The same is the expectation from every stakeholder. And in this context, financial reporting, standards, disclosures are a communication, and that communication has to be of highest order for us to ensure the respect of the profession. So thank you all for your patient listening. It was a pleasure interacting. I would love to do a face-to-face interaction. Thank you all.
Thank you, sir. Thank you so much for your excellent presentation. You have explained step by step and highlighted the important points so that the members will give the attention to those points while finalizing the audit reports. For me, it's like once again see a final classroom.
Yes.
Once again you have proved. Once again you have proved To all of us, you are the great teacher. A very big salute from SIRC for our dedication to the profession and the valuable time spending with us this in the great evening. Thank you so much, sir. Thank you so much.
And over to Jomon.
Now, yes, sir.
Thank
Now
you, sir.
over to our Vice Chairman Jomon, sir. Sir, you can proceed, sir.
Yes. Good evening to all of you. Hope I am audible and clear.
Yes, sir. Yes, sir.
Good evening to all of you. My very dear friend, the dynamic chairman of the region, K. Jalapati, very, very learned, revered teacher, academician, and a council member who has been guiding us for the last 6 years. Most respected MPV, who has done a wonderful dissection of the standards, the last standard IS 15, where the illustration was done. As Jalapati said, demonstrated the great teacher in him, and no wonder that he was such a big fan following, all of us included, that MPV is. So he required more time, but let's see, maybe Jalapati, I think one more follow-up session at his convenience could be for the rest of the standards, because up to 15 is the new generation, all generation standards, the new generation, A16 borrowing cost onwards. I think there was a need to reinvent, and therefore let's look at that. Now, and the other RC members, if they are there, and the 380 participants who are still on this late evening glued with us for this presentation. I'm extremely delighted to be with you virtually, though ideally it should have been a physical program in Chennai, but we are all confined, so it's better be careful than not. And we have been having a lot of deliberations. Congratulations and compliments to Jalapati and the entire team there, the office, the technology team, for bringing to us almost every day some program which is of high value addition and very, very relevant topics, as you said, conventional and then contemporary and futuristic. That is really nice usage from your side. So with that introduction, let me straight away move on to the presentation. This is about the Companies Act 2013, which is 8 years into its existence, but still evolving. And a big thank you to the chairman and organizers for this opportunity to interact with the elite colleagues across the region, close to 400 of them.
Visible, so you can start slide, Joseph.
Yeah. Is the full screen visible now?
Yes, now, sir. Yeah, visible, sir.
Yes, sir.
Yeah, okay. Right. Selva, I think you'll have to minimize the screen because I'm not able to see.
No, you can click on the PPT. The
yeah,
screen
fine.
is automatically. Yeah.
Sorry, say again.
No, sir. You can click on the orange arrow. It will minimize to right end, and if you click on the PPT video, it will go at the back. But you can just see the slides and speak, so that there is.
Let me just see.
For us, the PPT is fully visible, sir. Don't worry.
Yeah, but for me, I'm getting a zoomed screen of Jalapati.
1 minute, I'll just turn off. Now.
Yeah, now the slides are visible for you also.
Yes, sir. Visible, sir. No worries. You can continue, sir.
Yeah. Okay. Thank you very much. So, my dear colleagues, Companies Act 2013, as I mentioned, 8 years into its existence. Now again, still evolving, getting amended. They say that it is being decriminalized, and made ease of doing business being the top priority for our country, as we are expecting a lot more of FDI post-COVID problems because of the disfavor that China has earned for itself. So with that, the Companies Act is getting simplified. Today, before I start, I think I have a feeling that when I was traveling across as a faculty and year before last as the chairman of the region, I have a feeling that majority of the chartered accountants, including young CAs, have moved away from corporate law practice, which used to be our domain. I think we have pledged it with due respect to my fellow colleagues. If any one of the company secretaries are there, we have completely pledged it to company secretaries. So I would start with a clarion call to reinvent corporate law practice and get into that, particularly big firms with very many partners, like 5 to 6 partners. Let one partner concentrate on corporate law and compliance, of course, related laws like FEMA and things like that. So therefore, there's a huge scope for that. Our firm, for that matter, we have a partner who is specializing in this, and that's a separate vertical. It offers huge potential, right from incorporation to winding up. And today, sensibly, if you have an IBC partner, insolvency and bankruptcy court, a lot of things we can combine and develop value and, of course, revenues in our practice. So that is my first remark on this. Secondly, the Companies Act 2013, as I mentioned, it is not yet a settled law. Any reference to the Companies Act 2013 today should be by going to the website of MCA. On the left-hand side, top left, you have see the e-book, the Companies Act 2013. You can copy it from there. You can have a certain chapters taken out and stored on your desktop. And therefore, referring to any book, I remember seniors are there. We used to have the glittering Ramaya, which is kind of must for every CA office, sitting in the back shelves. And those books are not completely become redundant to some extent. And therefore, the only way we should refer to the Companies Act 2013 is by reading the e-book, which is administered by the ICAI and on the website of MCA. So with that introduction, let us move to the specifics. So we have 2 chapters to deal with today. I have made it simple, and I was handy that MBV had made it something like a classroom session. These 2 should be seen as a back to basics exercise. Those who are familiar with these 2 chapters, I think this will be, as Jalapati said, this could be a revision or a recap on what you have learned, and probably with some of the amendments incorporated in there. Of course, for those who are new, yes, this would be a learning exercise and probably one step into reinventing the corporate law practice. So chapter 9 of the Companies Act, chapter 9 deals with accounts of companies. We have both inclusive 11 sections in there. That is accounts of companies. And Companies Act 2013 is a delegated legislation. It's a delegated legislation, meaning that you have to essentially read it with the allied rules. Now, if you see the Companies Act, it said that it's been simplified. Number of sections have been reduced to 470 or so, but the allied rules are very, very important, should be read together. I'll give you a simple example. The definition of a relative. The definition of a relative, half of that is in the Act, and the other little bit of points, some more points are there in the rules. Here also, as the presentation unfolds, you would know that there are a lot of things. The rules are equally important. So always keep it together, and then that is the way we refer. So 128 to 130. We are going by section dissection. Books of account as defined in section 230 on accrual basis. Again, accounting standards. I too handle a lot of sessions on accounting standards. Tomorrow, day after, 3 days from tomorrow, we are having in Kerala 4 branches are jointly organizing a program on accounting standards, the basic compliances which are required, slightly on a different tangent from what MPV has shown us today. So accrual basis is given in the Act itself. It is an accounting assumption. Under double entry system, that is mandatory, and financial statements which give a true and fair view of the affairs of the company should be kept at the registered office. This is a basic requirement. And if it's kept elsewhere, notice should be given to ROC within 7 days if it's kept elsewhere. Now, today, physical books, in smaller companies, at least smaller companies, larger companies as well, physical books most of the time are missing, in the sense that we talk about data integrity, but the client most of the time shares the tally data or the financial software with the data even to the article files. But then if books of accounts, technically speaking, has to be kept elsewhere, it requires notice to the ROC. Now, the Act allows, when I said books of accounts, we are talking about seniors would agree. I did my articles in Chennai from 88 to 91. So we used to have the manual registers, we used to do the totaling, the manual work we used to do, tally the trial balances and things like that. Those basics we learn from. Today, it can be in electronic mode also. Technology is advancing, so hard copy is going out of fashion. Therefore, it can be in electronic mode. And books of 8 years preceding the financial year should be kept. I'm making a hyperlink to the applicable rules. About the electronic mode, it shall be remain accessible in India so as to be usable for subsequent reference. Shall be capable of being displayed, and the storage and retrieval should be there. Backup should be in servers in India and shall intimate ROC the details of the service provided. The summarized returns of books of accounts kept outside India shall be sent to the registered office on quarterly basis. This is about the basic aspects of books of accounts. And the next section is a very important section, section 129. Section 129, financial statements, new definition. Please refer to subsection 40, which defines financial statements to include balance sheet, P&L or income and expenditure account, income and expenditure for a section 8 company, and cash flow statements and SOSE, statement of changes in equity. But SOSE is not yet notified. So today, general purpose financial statements will include balance sheet, P&L, and cash flow statements. MPV did spend time on the cash flow statements, the differentiation between, or the operating activities, investing activities, and financing activities. But small companies, I put only small companies here, small companies, startups, OPCs, and dormant companies. I repeat, small, dormant, OPC, and startups are exempted from the preparation presentation of cash flow statements. So this is a new definition, and let's see what the section has got to tell us. Shall give a true and fair view in compliance with accounting standards. There's a separate section 133 empowering the central government. Still 129 places substantial thrust on saying that in compliance with accounting standards referred to in 133. And when we go to schedule 3, analyzing the schedule 3, accounting standards stand taller than the disclosure requirements under schedule 3. They are paramount, they are supreme than schedule 3 requirements itself. And it shall be in the form prescribed in schedule 2. As you are aware, we have schedule three divisions, division 1 for AS companies, division 2 for Ind-AS companies, and of course division 3 for NBFCs. So schedule 3 format, schedule 3 has undergone a substantial change. A lot of changes have been made recently, and there what we're going to touch upon as we go by. Please know that those amendments and CARO 2020, recent amendments to schedule 3 and changes to CARO 2020, revised CARO 2020 is applicable only from the running financial year 21-22, not for financial year 2021. The board shall lay the accounts in every AGM. That is what MPV was referring to, not finalization. The board approving the accounts, and then it shall be laid in every AGM. That goes without saying. Consolidated financial statements shall also be laid in the annual general meeting. Yes, the parent of the parent. Now here in red letters I put it. It created some confusion. This requires a bit of discussion, maybe 2 minutes. Subsidiaries should include associates and joint ventures. That's a misleading statement. Probably gave rise to a lot of confusion. But companies accounting standards rules 2016 said don't bother about consolidating subsidiaries and consolidating associates and joint ventures. Just comply with the accounting standard 23, which deals with investments in associates and CFS, and 27, financial reporting of joint ventures, financial reporting of interest in joint ventures. So we do not consolidate associates and joint ventures, continue to consolidate subsidiaries only. And let's see what the rules have got to tell us. And the statement containing salient features of the subsidiary, associate, and joint venture shall be in form AOC1, making a reference to forms as well. And the manner of consolidation is if accounting standards are applicable, do comply with. So AS21, for example, AS21 is not mandatory for small and medium companies, SMCs, as defined in accounting standards rules. But in the case of otherwise, if it's not mandatory, then it shall sufficient if it complies with schedule 3, meaning filing of this AOC1. Moving on, a statement of this we have seen, a statement containing financial statements. Subsidiaries shall also be attached to the financial statements. 129, again, giving a lot of thrust on accounting standards, where the financial statements of a company do not comply with AS, accounting standards. It shall disclose the following: AS or Ind-AS as the case may be. Now, Ind-AS, MPV did preempt Ind-AS from the discussion because today it was on accounting standards. Now, for whom are Ind-AS applicable? Ind-AS is now applicable for all listed companies, big and small. all unlisted public, private, government, private companies with net worth of 250 crores or more, 250 crores or more, only for them the Ind AS applicable, and NBFCs also. NBFCs with the same threshold of 250 crore or more, it is applicable. Ind AS is applicable for all the other companies. I'm presuming that most of the participants are from small and medium firms like mine, and therefore we have majority of our clients. We do have listed companies, we do have large public limited companies, but then majority of our clients are complying with accounting standards. So in this case, you do not comply with AS bar Ind AS, because if your net worth is more than 250 crores, or if happen to be a listed company, then it is Ind AS. It shall disclose the deviation, that particular deviation, the reason for the deviation, and the financial effect, if any, in such deviation. Financial effects of such deviation. This is not in the auditor's report. Financial statement 129 is the primary responsibility of the management. So that's a very important thing which we have to do. So that's about financial statements. 130 talks about, probably 130 and 130 when we will revisit after we finish the other sections which are more important in NFRA. The NFRA is a new regulatory authority, we did mention about that, which is gaining a lot of ground. And here the central government is notified, and it is established the NFRA to provide for matters relating to accounting and auditing standards under this Act. NFRA shall make recommendations to the central government on formulation and laying down of accounting and auditing policies and standards for adoption of companies and a class of companies or the auditors as the case may be. But they have not started doing this. NFRA has started taking disciplinary action, penal action against erring auditors. Like in IL and FS, it is taken action against 2 of the serving partners and 1 ex-partner of a multinational firm, and slash penalties to the extent of 20 lakhs, 5 to 7 years of barring from practice, and matters before the court, I think, and therefore that is how it is. And this is a purpose for which NFRA. So NFRA is a new regulatory authority about which every one of us have to be really aware of and be clear. And it will also monitor and enforce the compliance with accounting standards and auditing standards in such manner as is prescribed. Oversee the quality of service of the professions associated with ensuring compliance with standards, and suggest measures required for improvement in quality of service in related matters. And any related functions, a very strong authority, it is given a very strong authority. I hope some of you would remember that 2017, when Honorable Prime Minister Narendra Modi addressed the Chartered Accountants on July 1st, which is today the GST Day also. We celebrate it as GST Day also. He was given indication that there are erring members, and therefore there is a need to have stronger regulation, stronger supervision, and more stringent surveillance on the profession. That time, till that time, 132 was one of the last sections of the 2013 Act to be notified. So it is clear that it is getting notified. The government felt that it should have more of regulatory and supervisory and disciplinary powers on the members of the profession, not only chartered accountants, cost accountants, and company secretaries. And so came into existence the NFRA. And it also has the power to investigate suo motu or on a reference made to it by the central central government for such class of body corporates in such manner as may be prescribed, etc. This is a generic term, very, very empowering clause they have given to National Financial Reporting Authority. No other institute or body shall initiate or continue any proceedings if NFRA has started an initiated an investigation under this section. These are all the very important provisions of 132. And they have the powers which are vested in a civil court under the Code of Civil Procedure 1908, discovery and production of accounts, summoning and enforcing attendance of persons, inspection of books of accounts, issuing commissions for the examination of witness, documents, etc. Very, very wide powers NFRA is given. And NFRA 2, the form for listed companies, that also has become mandatory. So NFRA rules are separately from, and NFRA rules should be read together. One should really be aware that in addition to the disciplinary committee and disciplinary framework of our institute, there's a new reporting authority, NFRA, set up under 132, to which we are all subject to if they take disciplinary action. That brings us to the next section. We are going section by section. 128 books of accounts, 129 financial statements, 130 was reopening, and 131 was reassessment, and 132 NAFRA. We come to 133 now. The central government may prescribe accounting standards or any addendum thereto as recommended by ICAI in consultation with and after examination of the recommendations of NAFRA. This is clear, and in exercise of the powers so conferred, the central government has said that all the accounting standards of ICAI are mandatory and also are the indices. But nobody is formulating standards. The formulation of standards is still, thank God, the domain of ICAI under the Accounting Standards Board, which MPV was the chairman last year. Sorry. And till the NFRA prescribes, it is the NACAS, National Advisory Committee, set up under 210A of the erstwhile 1956 Act. But this is very old. But today, NAFRA has not started. The prescription stands there, and NAFRA would now gain more power. And as things stand now, the power under 133 has been exercised by the central government, and saying that all these 29-2 standards, accounting standards, are mandatory. Why is it 29-2? AS1 disclosure of accounting policies, AS29 provisions, contingent liabilities and contingent assets. But in between, two of the standards have been withdrawn. AS8 old case, AS8 on research and development, and AS6 on depreciation. 2016 amendment to the accounting standards rules withdrew depreciation standard AS6 and planted all that is relating to depreciation from paragraph 40 to 60, if I remember correctly, of AS10, accounting standard 10, which has also been renamed as property, plant and equipment in alignment with IAS 16, that is property, plant and equipment. So no more standard called accounting for fixed assets. 134 again, 134 ideally it should have been. 129 there is financial statements. They could have everything there. And 134 is financial statements and board's report. The financial statements, including consolidated financial statements, shall be approved by the board before it is signed by chairperson or chairman, if it's authorized, or at least by two directors. So most of the time we see that I see a lot of balance sheets, signed balance sheets, finalized balance sheets of private limited companies, which are signed by the auditor but not signed by the directors. These are all good practice. I think we should really insist on. Do not sign the balance sheet without getting approved and signed by the board of directors. Private limited companies might go for signature to them, but let them come back with the signatures, make sure that it's properly signed, only then associate our name with it. Of which one shall be MD and the CEO if he's a director of the company, the CFO, Chief Financial Officer, and Company Secretary if he's there. The auditor's report shall be attached to every financial statement. Board's report, the general meeting, the report of the board of directors. This is relevant because many of us small practitioners today help the management or support the management in preparing the financial statements. Of course, many of us do. There's a big catch there. And board's report also sometimes. The formats are there in those who have the corporate law practice, or it is given to the company secretary. And therefore, there's a huge need to understand the importance of the standard. But then today, under the new code of ethics, taking up management responsibilities which are outside the scope of the auditor's work has to be done very, very carefully, judiciously. Otherwise, there is a big risk there. Extract of annual return, number of meetings of the board, director's responsibility statement, we include all that, and declaration by independent directors under 149, explanation on qualifications of auditors as well as that of the secretarial report, related party transaction. This is something today one has to be extremely careful. We have section 188 on which we report under CARO whether the related party transactions are being carried out in compliance with 188. Section 189 register. Accounting standard 18 on related party disclosures. If it's income tax, it is 48(2)(b). And we also have a separate standard on auditing, SA 550 on related parties, which goes to the extent of asking the auditor to obtain a separate letter of representation in addition to the letter of representation we obtain under SA 580. That's a general one. SA 550, how the management has determined related party transactions, that they have disclosed all the related party transactions to the auditor and in the financial statements. That's very, very important. State of companies affairs, management appointment and remuneration, major changes that have occurred between the year-end and report. Subsequent events, MP was talking about that. Balance sheet date is 31/3/21, and if this week, end of July, we are finalizing, or 21st of July, we are finalizing that intervening period. What are the major developments? Particularly, this is so relevant in the COVID context. Talking about the COVID context, yes, let me also say that the institute came out with has issued 6 COVID-related pronouncements. In all that today, going concern in tourism industry, mass entertainment, there are a lot of concerns about they would be able to pull out because of the closure, because of the complete stoppage or the grinding halt. So the key aspect which every one of us as auditors should keep in mind is the fact that there's something called, we talk about professional skepticism. Professional skepticism is being a little doubting, asking more questions, doing deep dives, drill downs, and probably in layman's terms saying that, sir, we trust you, but still we would like to verify. And not taking explanations, people, documents for granted. Take it with a pinch of salt, add a bit of pepper. Be a doubting Thomas, as they say. And professional skepticism is a common thread of all the COVID pronouncements. It says that our conservative thinking, our professional skepticism, the judgment that we apply, all that the skepticism should stand substantially amplified. That's a very, very important aspect one should keep in mind. CSR initiatives and composition of the company. Larger companies, we'll see for whom they are applicable. All CSR details have to be given. And CSR also, today from 2021 onwards, we have to make a provision for the unspent amount of CSR in applicable cases. Performance evaluation, loans and guarantees, other matters as may be prescribed. So that brings us to, after 134, that brings us to section 135. And as I did mention that some of the members who are probably come back from abroad or resigned from or superannuated from employment, new in practice, I'll share the slide deck with the SIRC. SIRC would either display it on the website or individually. I can also mail it to you. That's absolutely no problem. One-to-one base, we can do that. So the framework of CSR has become very demanding for corporates now. Some of them are willingly doing it, but some of the listed corporates have been getting reprimands from MCA for not spending the CSR funds. Section 135 of the Act, Companies CSR Policy Rules 2014, and Schedule 7, which gives the complete list of eligible CSR activities. Yesterday, we were in a meeting of Kerala Management Association, where I'm the secretary. So we were reviewing on CSR funding, we were reviewing the educational activities that we do, the main objects of the association, whether that's eligible for CSR. Then if that is the case, the NGOs who are seeking CSR funds, just for information, taking a slight detour from the discussion, you should register on the MCA website by filing CSR 1. And one of the preconditions for filing CSR 1 is you should have a live 12-ware registration and ATG registration, and you should have it in existence for 3 years. This is a precondition incidental to this. So if that is there, then you can apply for CSR 1 and the approval comes in less than a couple of days. So that is something which is relevant when we advise our clients. And then today, Chartered Accounts do advisory service on CSR as well. Making the investing or rather large corporates and well-meaning NGOs with a lot of validation done, and so that CSR funding happens. So let's move on to the specifics. Every company with net worth of 500 crore or more, turnover of 1,000 crore or more, net profit of 5 crore or more, in the immediately preceding financial year shall constitute a CSR committee of the board, corporate social responsibility. It shall consist of, in the case of a listed company, minimum of 3 directors, of which one shall be an independent director. Other companies, any 3 directors, but private companies with 2 directors. Private companies, if you meet any of these financial threshold of net worth, turnover, and net profit, yes, then 2 is enough, because private company you cannot insist on 3 and the independent director and things like that. The CSR committee shall formulate and recommend the CSR policy, indicating the activities to be undertaken. Recommend the amount to be spent, identify the amount to be spent, and monitor the CSR policy from time to time. This is the domain area of the committee, CSR committee. The board shall consider the recommendations of the committee, approve the same, and make disclosures in their report. Ensure that such activities are undertaken and that the company spends in every year at least 2% of the average profits of last 3 years on CSR. 2% of the average net profits of the last 3 years. The profits will not include profit of overseas operations. MPV did make a reference to AS 11 on integral foreign operations, non-integral foreign operations, and so dividend received from companies to which this section applies. So that is also very important. So your net profit would stand reduced to that extent. Schedule 7, I think it's a very long list. Eradicating hunger, promoting education, promoting gender equality, empowering women, ensuring environmental sustainability, national heritage, armed forces veterans, war widows, training to promote rural sports, nationally recognized sports, contribution to PM's National Relief Fund. Even during the COVID time, I think there's an amendment to say that the CMDRF, Chief Minister's, this disaster relief funds would also be eligible for CSR. But CSR is again not tax deductible. You have to spend the money from 2021 onwards. The unspent amount on CSR has to be earmarked, deposited, provided for, and as MPV said, funded. And then the very important aspect is about that the detailed disclosures have to be made in the board's report about the CSR spend. And penal provisions have also been introduced, and rural development projects and so on. Some points to be noted here is that the spending has to be in India. Spending has to be in India. Political contributions are not eligible, and program exclusively for employees of the company. With in-house training programs would not be qualifying for CSR. That brings us to section 136. A copy of the financial statements, including CFS, the auditor's report, shall be sent to every member of the company and debenture trustees not less than 21 days. That's the requirement of that. 21 days it has to be sent. In the case of a listed company, now we have technologically advanced. Many of the people do not require the hard copies. So it's sufficient to keep it at RO for inspection, and statement having salient features of the above in the prescribed form who are entitled to receive unless the shareholder asks for full financial statements. The form prescribed for this is AOC 3. So in the case of a listed company, unless the shareholders ask for, it is sufficient to send the salient features and keep it at the RO for inspection. That is enough for the compliance. Central government will prescribe the manner in which financial statements to be circulated in the case of certain companies. We have seen every listed company shall place the above documents on its website, as also of the subsidiary on its website. And penalty for default is company 25,000, every officer 5,000. This penalty for default. So 136. So we have come from 128 to 136. This is a section which is very important. 137. That is where I said many of us are not doing the ROC filing, annual filing. It's a good revenue. This thing, if you specialize, it's not very difficult. Train a few people, have a separate vertical. It may take a year or two, but then once it settles in, it becomes just routine. Company incorporation today, everything is online. Even the stamp paper. Some of you would remember going to the ROC office. I've come to Chennai office. I've come to Coimbatore office for company registrations. Then the manual corrections used to be there. We used to sign across. All that's gone. So everything is online now. And new forms like SPICE and all that have come. Composite forms have Recently also there's a huge change. So let's reinvent corporate practice and filing of annual return 137. The AOC4 annual return, or audited financial statements to be filed with the ROC stems up from here. A copy of the finance that we have seen, if it is not adopted, it can happen that the AGM, the accounts are not adopted. The unadopted financial statements should be filed with the ROC within 30 days and which shall be taken as provisional till the adopted FS is filed. So even if the AGM fails to adopt the accounts within the due date, once the AGM is held, you have to file the unadopted financial statements with the registrar of companies. Subsidiaries incorporated outside India shall also be attached. Here we are talking about the second paragraph is where the AGM has not been held. The financial statements along with statement of reasons for not holding AGM shall be filed with ROC within 30 days of the due date with the fees. The first case where we said that the AGM has been held, the previous slide, AGM has been held, but financial statements have not been adopted. This is one step further, AGM could not be held. Then the financial statements along with statements for not holding the AGM should be filed with the ROC within 30 days. That's 137. And with this is about the last section. Ideally, it should have been in the next chapter because that is about audit. So internal audit could also gel better with the chapter 10. But the last section in chapter 9, accounts of companies, is internal audit. Certain companies shall appoint internal auditor who shall be professional as decided by the board. So need not be a chartered accountant to conduct internal audit of the activities and functions of the company. The central government has prescribed the rules, and let's see for whom this is applicable. Every listed company is a huge list. Every listed company, unlisted public company, paid up capital 50 crore or more, turnover 200 crore or more, loan of 100 crore or more, deposits of 20 crore or more. Turnover of 200 crore or more, loans from banks, financial institutions 100 crore, and this is the limit. And this was earlier. Even an employee of the company could be appointed as the internal auditor. CS may be in practice or not, and board audit committee shall decide on the scope, etc. This is the requirement which they had given for the internal audit section 138. So that's chapter 9. So to have a quick recap, the provisions of the Companies Act relating to accounts and audit are very, very important. I would strongly suggest, if some of you are trying to make a beginning, read one section a day. So we're talking about only 11 sections, 128, 138, both inclusive, relatively simple to understand, and there's some technicalities, but something like, anyway, you'll have the slide deck with you for reference if required. So that is something which every one of us or one partner should become a corporate law and compliance partner. Because tax practice, the customary practice, or rather the compliance practice, as we see, is fading out. Very unfortunately, tax audit limits are getting increased to 10 CR. GST audit is kind of disappearing. So therefore, one has to be focusing on newer areas. It could be business valuation, it could be IBC. A lot of our people, including past president G. Ramaswamy sir from Coimbatore. So he said he was watching a particular program on TV. And he said, I stopped watching that and started studying for 1-2 hours every day. And then he's qualified, and today he's doing very high stake IBC cases. So he's a company secretary as well. You know that, G. Ramaswamy sir. So many of us can still, I have seen Manoharan sir, our past president, Manoharan sir, in an IFRS class in Savera Hotel. I was his classmate in that session, jotting down notes on IFRS classes. And of course, then I have also heard it taking sessions on specified IFRS in Dubai and in Abu Dhabi as we travel there for certain assignments. So this is certain things which we should learn from our revered seniors. That brings us to the next chapter, chapter 10, Audit and Auditors, 139 to 148, 10 sections. And also be clear about companies, audit and auditors, rules 2040. First is naturally about the appointment of auditors, 139. those who are seniors would remember it was 224 under the Companies Act 1956. Every company shall its first AGM. It doesn't talk about the first auditor. It talks about shall at the first AGM appoint an individual or firm as an auditor who shall hold office from the conclusion of that meeting till the conclusion of the 6th AGM. I have highlighted that. 6th AGM and thereafter till the conclusion of every 6th annual general meeting. So under the Companies Act 2013, the term of the auditor is 5 years. 5 years as against 1 year in the 1956 Act. Today we see a lot of change in auditors. Management wants to change. But today, if you get an appointment letter saying that you are appointed for 1 year, 2 years, like that, you have to say that the appointment is irregular. The AGM resolution has to clearly say that you are appointed for a period of 5 years. All right. Okay. So this has to be very clear. And a lot of people, many of the disciplinary cases, which again MPV was referring to, is majority of the disciplinary cases are for not communicating with the previous auditor. Many of the people, when they are approached saying that management would say that the other auditor is not interested, we would like to appoint you, they happily accept. No, there has to be it has a general, if it's a resignation, if it is a casual vacancy, death or disqualification, board can do it. Otherwise, if it's a resignation, it can be done only by the company in general meeting. So there has to be a general meeting resolution. We have to ask for it. There has to be an appointment letter. You have to file a ADT1. And you have to also probably make sure that the resigned auditors filed ADT3. You have to communicate with them, make sure that his fees has been duly paid. All those things have to be done. So it is not that suddenly when somebody says that, sir, why don't you take up the audit of a company? We cannot jump into that. These are the basic precautions. 5 points I have mentioned we should take care of. Before appointing, every company shall obtain a written consent from the auditor and a certificate that appointment is in order and that is not disqualified under section 141. Disqualification 141 we are going to see in a few slides from now. The company shall inform the auditor and also file notice of appointment with ROC within period of 15 days. Who shall inform? It is the company. Earlier on we used to file, it was the auditor's responsibility. The company, most of the time we do it, but then it is the company's responsibility. And as you know, notice to ROC, auditor's appointment is in ADT1 and 15 days, not 1 month. If it's resignation, it is 30 days. So this is 139, but a lot more provisions under that. It's a very lengthy section. Non-listed company or class of companies, as may be prescribed, shall appoint an individual as auditor for a period of more than 5 years and a firm for more than 2 terms of 5 consecutive years. If it's an individual, it can be only for 5 years. But as a firm, it can be 2 terms of 5 years. And I've used a layman's term, a 5-year cooling. Cooling is something which we use in the bank audit sphere. A 5-year cooling is also envisaged after you. So as an individual, you complete your 5-year term. Then if the company feels that the love still remains even after 5 years. So 11th year, you could be reappointed as the auditor of the company again. But the 5-year cooling is required. The central government may prescribe the manner of rotation. This is how audit rotation has been enabled. And unlisted public, all listed companies, yes, goes without saying. Unlisted public companies with paid up capital of 10 crore or more. Private companies paid up capital of 20 crore or more. All companies except OPC small companies having borrowings, public deposits of 50 crore or more. They would also become public interest entities. Though they are, private, this 50 crores of exposure, public deposits and borrowings mostly from banks is there, then these are the companies to which rotation is applicable. And the rules go on to say that firms under the same network is not allowed. I'm sure some of you are aware about the new networking guidelines. New networking guidelines is an umbrella to develop, as the Prime Minister envisaged, contemplated and dreamt, to have a multinational firms within India itself, capable of 100 partner firms, large firms who can take up the audit of, multi-billion business conglomerates. So there's network guidelines are coming in there. And we also have the network of the Big Four. So within the Big Four itself, if, for example, if Batley Boy and Lovelock Lewis are under EY, So it cannot be the firms on the same network is not allowed. Or if Fraser and Ross for a Southern Fraser and Ross in Bilimoria under Deloitte, then they are not allowed. Partner resigning and joining other firm is also not allowed, because once the term is over, then I can resign and join another firm, and that's not allowed. The members of a company may resolve to provide, the company is given a right to, for the members are given a right to resolve that the audit partner and his team shall be rotated. It is essentially a matter internal for the audit firm, but they can give a direction saying that the signing partner, the dealing partner, the audit partner, because this is again familiarity over a period of time. We have found that the same partner, the same firm continuing within this thing impairs independence. It impairs independence. Familiarity breeds contempt. They say here it's not contempt. Familiarity probably is taken advantage of, taken casually. Explanations are trusted so much that we have been to, I know the MD for 20 years, very close to me, and this distant relative has married my sister's son. And so all those things are there. So that is there. The audit shall be conducted by more than one auditor. That is how joint audit is also enabled in section 139. That is about the company getting appointed the first AGM. But every company shall, the first auditor shall be appointed within 30 days of registration, incorporation. First auditor, who can do it? It can be done by the board. First auditor can be appointed by the board. And if not done, it shall inform the members of the company who shall within 90 days at an AGM appoint the first auditor who shall hold office till the first AGM only. Because the section starts, 139.1 starts by saying that every company shall its first AGM. So that's what is happening prior to the first AGM. Ideally, the board would appoint the first auditor within 30 days of incorporation and who would hold office till the first AGM. The first auditor of a government company shall be appointed by the C&AG within 60 days of registration. Okay, CAG has to do it in 60 days. But here, look at that. If C&AG fails, the board is given a superseding power to have the appointment of a government company within next 30 days. Then if the board fails, as in a private company or a non-government company also, here it is 60 days. In AGM, appoint the first auditor who shall hold office again till the first AGM. AGM again, the power of C&AG would come. Every financial year, the C&AG shall appoint the auditor within 180 days from the commencement of the financial year. 180 days. So 6 months time roughly is given for the C&AG to appoint. So 22 appointments, running financial 21-22, we have the C&AG has time till September 30th to roughly September 30th or October, September 28th or so to have the auditor appointed. Casual vacancy other than by resignation shall be filled by the board within 30 days. Casual vacancy. Vacancy arising by resignation can be filled only by the company in general meeting within 3 months from the recommendation of the board. This is something one should be very clear. If it's a resignation, the board cannot do it. It has to be in general meeting. And you have to make sure that the provisions of the articles of association have been complied with and notice has been sent with the required number of days as mandated by the articles, or else consent has to be given by 90% of the shareholders. Then the EGM has been held and the resolution has been passed. A certified copy of the EGM resolution is attached to your appointment letter. Please do make sure we cannot be casually taking this in the case of a resignation. There could be disputes, there could be reasons for the audit resign. And the MC is also not very, they're not taking very lightly the auditor's resignation. The reason should be very clearly given. Due to other preoccupations, I am resigning. Those things MCA is not accepting. Therefore, one has to be thoughtfully accepting and exit only in very difficult situations. Casual government companies there. Look at this. This is talking about the auditor appointed under 139 may be removed from his office before the expiry of his term only by a special resolution after obtaining prior approval of the central government. So cases where the auditor is like, for example, in the first AGM, you have been appointed as the auditor of the company for 5 years. So till the 6th AGM is your term is till the 6th AGM. Before that, if you have to be removed, then appoint another person, then it will require the prior approval of the central government. The auditor shall be given an opportunity of being heard, naturally, yes. First auditor appointed by the board may be removed by the company in general meeting before the first AGM. That's the wording is slightly confusing. Within 30 days, ideally within 30 days of incorporation, the board would appoint the first auditor. But the shareholders after some time feel that, okay, this audit is not performing. So shareholders can convene an EGM and remove him. Normally his term would have been till the first AGM. Even before that, he can be removed in the EGM. The auditor who has resigned from a company shall file a statement with ROC and C&AG within 30 days indicating the reasons and facts of his resignation. This is ADT 3. But the penalty, look at the penalty, the fees would not be as much. Fine for non-compliant 50,000, that was original this thing, but or his remuneration, whichever is less. Continuing failure, 500 rupees per day, limited to 5 lakhs. So ADT 3, once you resign, resignation is final, you give to the board and make sure that ADT 3 is filed. This is more of the auditor's responsibility, whereas ADT 1, appointment of the auditor has to be the responsibility of the management. Two questions here. For the first appointment by the board, ADT 1 is not required. I repeat, for the first appointment of the first auditor by the board, ADT 1 is not required. Now, there was a requirement of ratification every year. That's also done away with now. There's no ratification. You are appointed for 5 years. So annually, do you have to file the ADT 1? The answer has been clarified by the MCA that you don't have to file ADT 1 every year. 5 years you appoint. Here is talking about appointing an auditor other than a person retiring, other than the retiring auditor. You know, our old section 225, special notice is required. That is a 14 days by the member on the company. Special notice is always a special notice is noticed by the member on the company. 14 days notice that I would like to move a resolution stating that the retiring auditor shall not be appointed, or that's I would like to appoint Y in place of X. And then on receipt of such a resolution, notice for resolution, the company shall immediately send a copy of that to the retiring auditor. And the retiring auditor has a right to make representations of reasonable length. And once that is sent, the company should circulate it to the shareholders. That's a simple provision. And if it's received late, the auditor can demand that this be read out in the AGM without prejudice to his right of being heard in the AGM. That's a very important thing. And that is very, very interesting. But the tribunal, today the NCLT, you have a right to apply to the NCLT saying that the auditor is trying to mar the image of the directors without reason. The term used in the earlier act was to gain needless publicity for a defamatory matter. Then it can apply to the NCLT, and the tribunal, if it is convinced, shall say that you have received the representation, it need not be given publicity, it need not be circulated to the shareholders. The tribunal may suo moto on an application made by the central government or any person concerned that the auditor has acted fraudulently, direct the company to change its auditors. So NCLT has those powers. All these powers have been shifted to the tribunal. It can also act, if the company there's a delay, it can also act the auditor not to function. The given of this thing, and if such a thing happens, then a 5-year ban is also envisaged if so removed by the NCLT on a complaint by the central government or any person concerned. That brings us to 141, eligibility, qualification, and disqualification of auditors. Only a chartered accountant can be appointed as auditor of a company, or a firm where majority of the partners are CS may also be appointed as auditors. Majority of the partners are CS. Now, as many of you may be aware, the MDP framework has been approved. The multidisciplinary partnerships are going to come into existence. Today, you are allowed to partner with advocates, company secretaries, cost accountants, MBAs, tech guys, and all those things are possible. Architects, engineers, all of them. So therefore, I think for many of the firms, medium-sized firms, like we are surely looking at having a techie as a partner. We are having somebody as a consultant. Probably going forward, technology is making deep inroads into the way we function and taking away some of the opportunities. So there should be someone who can communicate with machines, understand the future of how this is happening. So that kind of thought, just sharing a personal note with you, striking a personal call. So where a firm including LLP is appointed, only CA partner shall act and sign for the firm. This is very clear. Disqualifications. Body corporate other than LLP. Now LLP form, many of our friends have formed LLPs. An officer or employee of the company, goes without saying. A partner or employee of an officer or employee of the company. They are all disqualified. A person or firm who has direct or indirect business relationship. We'll see what it is. With the company, its subsidiary, holding company, associate company, and subsidiary of a holding company. So fellow subsidiary, that's a fellow subsidiary. The rules say that business relationship has to exclude professional services of a CA. It's not business relationship. Transactions in the ordinary course of business by telecom, airline, hospitals, hotels, and other similar business. Very generic exemption they have given to the term a business relationship. Probably like a telecom company, you are using a Reliance Jio, that is, that's not a business connection per se. Or you are regularly flying, let's say, Vistara, and does not disqualify from becoming the auditor of that company, or the same related businesses. Not a core business transaction, the normal course of life in business as life moves faster lane. That is the business relationship they have said. Relative, in the 1956 Act, relative was not disqualified. The person who's a relative of is a director, KMP of the company, who's relative of, not is a director, a person whose relative is director KMP of the company. A person who is in full-time employment elsewhere. Full-time employment, if you're there elsewhere, you cannot become the auditor. Holding the audit of more than 20 companies. This is the ceiling they have put. So if the person for firm who is holding audit of more than 20 companies, but from this, you know that there's an exemption. Private companies do not come in the ambit of this, so they are not counted for this ceiling of 20. A person who has been convicted for fraud for a period of 10 years has not elapsed. This is again a long list. A person whose relative partner is holding any security or interest in the company. Even holding one share in the company, subsidiary, holding company, associate, fellow subsidiary of face value exceeding 1 lakh. One share may not be having 1 lakh, I stand corrected. So face value exceeding 1 lakh. Indebted to the company for an amount of, not only to the company, for an amount exceeding 5 lakhs. You remember what is the limit under 1956 Act? It was 1,000 rupees. Now, a lot of inflation allowance has been given, and you have this 5 lakhs limit now. Same, if it's not a loan or indebtedness to the company, you could make somebody else take a loan and stand guarantee for it. That is also prohibited for an amount exceeding 1 lakh. Any person directly or indirectly rendering any service provided under section 144. What is 144? We are going to see that in 2 minutes from now. 144 is prohibition on the chart, not the chartered account, prohibition on the statutory auditor providing management services, multidisciplinary services. We'll see that. Remuneration is fixed by the general meeting or in such matter decided therein. Normally what happens is the general body would say that such and such firm is appointed as auditor for a period of 5 years for a remuneration to be discussed by the board and finalized in consultation with the auditor. So though the power is with general meeting, it is normally delegated down to the board to discuss with the auditors and finalize the audit fees. The board may fix the remuneration of the first audit, naturally. That brings us to a very, very important section, 143. The caption is powers and duties of auditors and auditing standards. Auditing standards. Rights, empowering rights are given to the auditor to give access to books of accounts and vouchers. Right to ask questions, secure information from the officers of the company. And these rights will apply to subsidiaries as well. when it comes to matters relating to consolidation. The first part here is 143. Here the auditor shall inquire, and here it talks about inquire, and it should have been ideally the auditor shall inquire and report if the findings are negative or if there are adverse findings. Okay. The other part, when it comes to 143.3, it says that the auditor shall report, which means that even if the findings are not negative or there are no adverse findings, you have to report. That is what 143.3 says. Like, for example, proper books of accounts have been maintained. Here, whether loans and advances made by the company on the basis of security are actually secured, and is anything prejudicial to the interest of the company. Loans and advances given to various different parties, outside parties, inside parties, related parties, all those things you have to see. Transactions of the company which are represented merely by book entries are prejudicial to the interest of the company. MPV was so detailed explaining the entries, liability, expense, debtor, liability, credit, and things like that. So here is sometimes it can happen. I've seen in the Middle East, it's a very common practice. When there's capital erosion, the promoter, the Emirati, would say that I have so much property on that highway and near the highway, or it's very close to an area where commercial or industrial complex is coming up. And okay, they would just pass an entry and say that the land account letter to owner's current account or whatever, or partner's current account, or shareholders' current account. But without conveyancing, it cannot be done here. So we have to see which are those transactions which are like a sham. And going on, where the company not being an investment company or a banking company, where the assets of the company being shares, they have been sold at a loss. If you're an investing company, banking company, it is part of your business. If you are like your non-trade investments, we used to call them, they have been sold at a price less than the purchase, at a loss. Loans and advances are given as deposits. They shall inquire. Personal expenses have been debited, charged to revenue expense, personal expense of directors. But it is stated in the books of accounts, documents of the company, that shares have been allotted for cash, whether cash has actually been received, and if not, whether the actual position is given in the balance sheet and it is regular and not misleading. So this 6 points which are very relevant, the auditor shall inquire and should ask, and then report only if there are adverse findings. Look at this. The auditor shall make a report on the financial statements laid before the AGM, duly taking into account provisions of the Act, allied rules very sensibly, accounting standards. We saw so much of the thrust on accounting standards. They are stronger than Schedule 3 requirements. A lot of non-compliance amongst the membership, FRRB findings, and we were sharing with us. Auditing standards. Auditing standards in the next third slide, I think from here, I think we can conclude in another 10 maximum of 10 minutes, not more than 10 minutes. I don't think I'll require that much. So auditing standards, yes, auditing standards are mandatory today. 143.9, we'll see that. And matters to be included in the auditor's report under the Act and the rules. These are the things the auditor should take into account while issuing a report on the financial statements audited by him. The auditor shall report whether the financial statements give a true and fair view of the state of affairs, profit or loss, and the cash flow, if cash flow statements are prepared. This is very, very important, section 143, duties of auditors, what the auditor shall do. The auditor shall also state whether he has sought and obtained all the relevant information, explanations which is necessary for the purpose of the audit. That's the first line in the auditor's report, and such information on the financial statements. Whether in his opinion, proper books of accounts as required by law have been kept by the company. So far as appears. So books of accounts defined in 213, basically all receipts and payments, all purchases and sales, all assets and liabilities. These are three things: receipts and payments, purchases and sales, assets and liabilities. And 4 is, if prescribed by the central government under the cost records rules, whether those cost records have also been maintained. Branch office, the auditor shall report whether the branch office appointed by, or branch office audited by another auditor, whether He has been sent the details and how he has dealt with in preparing the final report of the company as a head office auditor. Naturally, point number D is balance sheet and profit and loss account dealt with in the report are in agreement with the books of account. So I'll ask you a small question here. Here I would take questions if there are at the end of the session. And the question here is, how many of us really obtain a final signed trial balance in the course of an audit in building up the working notes file or the current file, as the ASA 230 used to insist. The pre-revised 230 said you should have a permanent file and a current file. For the purpose of the current file, a signed trial balance, how many of us do obtain? I think very few of us. So those are things which should insist as part of the audit program. And a few years back in my office, we are 8 partners, 5 in Kochi, 2 in Trivandrum, and we have a partner who's in Dubai. And there is a checklist we brought out, say checklist for the partner signing the balance sheet. The checklist has to be filled up, and me as the chief executive partner, I would put the final signature after the dealing partner, the engagement partner, signs this checklist. These are controls which I think good practice which we can do about. And also peer review. Every one of us should be prepared to face peer review, pass and get the peer review certificate, which is said to be a hallmark of professional excellence. The institute is saying that yes, your processes, your compliance with standards, the internal processes of dealing with an audit or assignments have reached a certain level of maturity, and therefore you are given the certificate of acknowledgement certificate, which is a hallmark of professional excellence. Okay, whether in his opinion financial statements comply with accounting standards are referred to in section 133. Very important point. The auditor has to. So we also have a checklist as part of the audit program. We have the audit assistant has to make a list of accounting standards which are applicable as a separate checklist and make sure that they are complied with. Observations on financial transactions which have adverse effect on the functioning of the company can happen. Whether disqualification of directors under 164(2), adverse remark relating to maintenance of accounts and other matters connected therewith. For according to me, this H is not required because back somewhere in the main body of the report, we are saying that proper books of accounts as required by law have been kept. So but then this additional requirement, adverse remark relating to maintenance of accounts, probably inventory records and things like that, we are committing under CARO, but here is an additional requirement about that. This is internal financial controls with reference to financial statements, the new things which are there. And IFC reporting, it's not internal financial controls. Finally, it is turned out to be ICOFR, which is internal controls over financial reporting only. Not the whole government of internal financial controls and entity can have, the auditor cannot. Rather, the scope of this has been reduced to that extent, or rather relaxed to that extent. But there have also been subsequently, if you're a small company, your turnover does not exceed 50 crores, your borrowings does not exceed 25 crores, and if you fully comply in filing annual return under section 92, that is MGT 7, and AOC 4 under section 137, if you're fully compliant, I repeat, turnover, you're a small company, you don't have to do IFR reporting, IFC reporting. If your turnover is less than 50 crores, borrowings less than 25 crores, and if you're fully compliant, there are no backlogs in ROC filing, etc., of this annual return and in the financial statements, yes, then you are exempted from IFC reporting. The other matters are not very distinct, so we can move faster. And if any of these things is answered in the negative or with a qualification, the auditor's report shall state the reasons therefore. You just cannot say that it doesn't give a true and fair review. Doesn't give a true and fair review, adverse opinion. And today we have SA 700, the format of the auditor's report. SA 700 should be read with SA 705, modifications in auditor's report. Tells us how to qualify a report, how to issue an adverse opinion, how to issue a disclaimer. And there are formats for that. Opinion comes first, and then the basis for qualified opinion, basis for adverse opinion, basis for disclaimer. Government company, yes, that's fine. Yeah, the government company is controlled directly by central government may direct the auditor in a manner in which accounts of the company are required to be audited. The C&AG's checklist we have in addition to the report. we all giving that those who are experienced in C&AG audit would know. I think we'll speed up to and round up. The branch office, I think, leave out. This is very, very important point. 143.9. The auditor shall comply with auditing standards prescribed by the central government, recommended by ICAI in consultation with NAFRA. But if you read the act, it very plainly says that every auditor shall comply with auditing standards. So SA 200 to SA 706 or 720, so many standards. There again, the compliance standards are very poor. We have to improve on the compliance. 2 years back, the institute made 2 topics mandatory for region. Jalapati, I think, is still there, is chairman, and for the region and also for all the branches. If some of you are listening, you know. One was standard on auditing. And after experiencing that, the level of knowledge of the members, like MPV said, poor awareness, regular references are required. We are a very dynamic environment. Some of the big firms have partners who are designated as partner learning, and who would be spending all the time on tax return filing and things like that. Learning is much essential, and updations to be abreast is very, very difficult, very challenging. CARO 143.11, CARO comes out of this. The central government may, in consultation with NAFRA, by order direct that certain companies' auditors' report shall also include a statement on matters specified there, and that is CARO, how it has come. Fraud reporting is a very important area. So the auditor shall report to the central government if the magnitude of the fraud is more than 1 crore. Otherwise, it's enough to report to the board. 144, please take note, a very important section. An auditor shall not render the following services to a company, its holding company subsidiary, directly or indirectly. Please note, this is an auditor. I can prepare a internal finance control manual or a project report, a feasibility report, a valuation report of a company who is not my audit client. This is not on the chartered account. This is not a prohibition on a chartered account. For example, a company in Trichur, my friend is calling up and saying that we are auditing this company. They want you to develop a, accounting manual or internal audit. I can do it. But as auditor of a company, I cannot be doing the following services of that company, its holding company subsidiary, directly or indirectly. Indirectly saying that I'll form a firm with, a consultancy, I'll form a firm, or with my spouse. Many of the members have been doing that, so that's also not advisable. Accounting and bookkeeping, no. Internal audit, no. Design and implementation of financial information systems, actuarial services, AS 15, we have seen actuarial valuations mandatory, even for small companies. Investment banking and investment advisory, outsourced financial services, management services, any other services as may be prescribed. Coming to management services, attestations are not coming under this. Attestations are not coming under this. So you can be if tax audit is applicable, you can be the tax auditor of your statutory audit client. You can be the GST auditor. GST audit is gone. And tax representation also can be done to that extent. Certifications can be done. So other than that, management services, ROC filing, for example, ROC filing with your on DSE, it should not be done. So this is a prohibition which is there. Signing, all of us know that shall be signed the auditors whose functioning of the company shall be read out in the AGM. That's fine. We can move faster. The auditor shall attend the AGM and personally or through a qualified representative. But there's no penalty for this. All notice should be sent to him. He has a right to be heard on matters concerning him as auditor. The auditor shall. It said mandatory, but there's no penalty as well. That brings us to the last section, 147. If any of the provisions of 130 and 140 is contravened. Okay, 130, it should be 144. The company shall be punishable with a fine of 25,000 to 5 lakhs. Officer imprisoned of 1 year and fine or fine of 10,000 to 1 lakh. The auditor, if he does not comply with 139 appointment, 143 Powers and duties. Duties of auditors. 144. Multidisciplinary services. And 145. Signing of the auditor's report. Fine is 25,000. 25,000 to 5 lakhs. But if it is found to be willful, then look at the punishment, 25 lakhs, so 8 times his remuneration, whichever is less. And should also refund the remuneration. Shall also pay damages to the company for loss arising out of incorrect reporting. Partners of the firm and partners and the firm to be responsible jointly and severally. That brings us to 148. For companies for whom cost records are prescribed, the central government may direct that a cost audit be done as may be prescribed. So I think I have hyperlink there. No, this is going to the Companies Act. That's nice. Okay. So which are the companies to which the cost records and rules would apply? The turnover criteria said is regulated industries. I've given a complete list. I've not given. Like fertilizer, total turnover 50 crores and 25 crores of current assets items. Non-regulated industries, total turnover 100 crores and current items of 35 crores. If it is there, then you should maintain the cost records as well as the cost audit done, if so prescribed by the central government under 148. So that brings us to the, this one more is there. The cost auditor shall comply with cost auditing standards, like accounting standards have cost audit standards, like we have auditing standards. Statutory auditor is disqualified and the cost auditor should submit his report to the board and forward the same with explanations for reservations to the central government within 30 days, because directed by the central government. So that brings us to the end of the presentation. Thank you so much for all of you for staying through till almost 9 o'clock, and we still have so many participants who are glued with us. And thank you, Jalapati. Thank you, SIRC, for giving me another opportunity of interacting with the elite professionals and on a topic is very important. It's always a disadvantage to speak after MPV, but today the topics were different, of course, quite interconnected, but one is core compliance with accounting standards and non-compliance is bringing about that awareness. And I was given this topic of the provisions relating to accounts and audit under the Companies Act, Chapter 9, Section 128 to 138, Chapter 10, Section 139 to Section 148. So we have covered all the sections except to 130 and 139, reopening of books of accounts and those two sections. 132 NFRA, be aware of that. 135 corporate social responsibility. A lot of changes are happening in this sphere. So with that, let me conclude. It is back to you. If some of you are there, it's back to you. It will be my pleasure to, if there are questions even. Selva, are you there?
Selva, is there any questions?
I'll share my screen, sir.
Yeah, please.
So we have some questions that that was
Okay.
compiled during MP visa session. Do you want to take it up or else go from here?
No,
Just
for this Jomon session.
Mostly our questions are to accounting standards related thing.
Selva, is there any for the second session questions?
That is, I just scroll down so you can just about the topic. So
I can probably attempt to answer some of the questions. I think this case of a new company. Okay. Okay, this is for me. Qualified audit report where actual valuation report is not permitted. I will start with question 6. How we have to qualify a report where actuarial valuation report is not obtained. Sir, we have a reporting requirement that all accounting standards are complied with. In the main body of the report, you would say that except AS 15 on employee benefits, as provision has not been made on the basis of actuarial valuation and the financial effect of which has not been quantified. That is the way you do it. And you have to go to extent where if there's a huge amount, it's a small company, but then large amount is there, but to that extent it may not happen. If it is huge, then true and fair also may be at stake, one has to see. But otherwise, except AS 15, as provision has not been made on the way, or rather as actuarial valuation has not been obtained, and the financial effect of the non-provision has not been quantified. Whether the IFC exemption to private companies needs to be verified every year or once the IFC is applicable, always applicable. No, if you slip below that turnover limit, if you come down, then you can take exemption. It is not fully applicable. Like it is once IFC applicable, not always applicable. So if a company made applicable for IFC because of non-compliance IFC, then whether IFC applicable for all subsequent years. Once you become compliant, clear all the backlogs, and once you become compliant, then you can avail the exemption. Question 9, Selva, you can go down. Sir, in the case of merger of CA firms, whether casual vacancy arises, question 9, again, whether casual vacancy arises for audit assignments of the firm which gets merged into another firm and not in existence anymore after the merger. Should ADT 3 in old name or fresh ADT 1 in the new continuing name be filed? In the case of merger, what happens is one firm is, so that firm ideally what I've been suggesting, there's no very clear-cut guidelines there. The firm that is getting merged, that should resign. And then ADT 3 has to be filed, and the new firm, the merged firm, has to file ADT 1. You are right. That's the way it should be done. So one firm is ceasing to exist. So just before the merger, it is better to give a resignation and inform the management that end of the day that it's a combined version of the existing firm. ADT 1, come down, Selva. ADT 1 is not required to be filed for the appointment of first auditors. In case the board files to appoint and the shareholders appoint the first auditor in the EGM, even such ADT 1 is not required, in which case ADT 1 is needed then. No, even in that case, it is not required, because that is in relation to 139.1 is that they say that ADT 1 has to be filed. 139 talks about appointment by shareholders in AGM. And here, because the board has defaulted or rather failed in their duty, EGM is appointed. He will hold office till even the one who is appointed as first auditor in the EGM will hold office till the first AGM only. There also ADT 1 is not required. If a company has not prepared consolidated financial statement, what is the auditor's responsibility by issuing the auditor's report on standalone financial statements? Okay, you are a holding company, and the company, your client is a holding company, and it has not prepared consolidated financial statement. On standalone, I don't think there is any responsibility for the statutory auditor of the holding company while reporting on the standalone company to comment anything on the consolidation. Also, can statutory auditor of the company issue a compilation report on company's financial statement? Yes, a statutory auditor of a company can issue compilation report in accordance with SRS 4410. But most of the time, what happens is, sir, they would want it for banking purpose immediately after the close of the financial year. But then, if there are huge deviations from the compilation report issued from the when we audit that, there could be some backlash. But statutorily or regulation-wise, there is no prohibition in the statutory auditor for company issuing a compilation report before the statutory audit is done. In the case accounts are maintained in tally system, instead of trial balance, P&L and balance sheet should suffice in place of final trial balance. Clarify. In the case of accounts maintained by tally system, instead of trial balance, the P&L and balance sheet should suffice in place of final trial balance. Yes, sir, but I would still suggest that we have a detailed opening balance, transactions, debit, credit, and closing balance kind of a trial balance to be, that is the basis for financial statements and balance sheet. Even that is fine, but I would strongly recommend that we have a detailed trial balance signed by somebody at the FM level. You ask, then you will see the resistance. If my company does not have any transaction related to government grants, then still require comment about non-applicability of AS. No, you don't have to mention anything about government grants, because AS 12 doesn't come to play. To the applicable transactions where AS will come to play, only you have to mention. In 2021, Mr. X got disqualified as auditor since the company invested in March 2021. Since company invested in March 2021, another company, ABC Limited, in which Mr. X is a director. The auditor was subsequently Audit was subsequently done by Mr. Y. After the audit of XYZ Limited, Mr. X and Y got into partnership, say, in September. Is this possible? Please note the disqualification was removed from May 21 when the investment was withdrawn or falls below 5% of the paid up capital. In 2020, Mr. X got disqualified as auditor since the company invested in which he is a director. Okay, auditor was subsequently done by Y. After the audit of XYZ Limited, X and Y got into a partnership, say, in September. Is this possible? It is possible, and you would become disqualified. Please note the disqualification was removed from May 21 when the investment was withdrawn. That part is not clear. When investment was withdrawn or falls below 5%. 5% of paid up capital is not there in the case of the disqualification under 141. It's the amount which is mentioned there, it is 1 lakh. The last part of the question is not fully clear. Any more questions, Selva? 135(5) amendment to deposit funds in bank account is prospective or prospective 2021. Sir, it is 1920. That is not mentioned. So that's an interpretation. The interpretation is that it is applicable from 2021 onwards. So whatever is pending in 1920 remains as it is. 2021 unspent amount has to be provided for and also should be funded. That is my view on that. So you don't have to go back retrospective to 1920 and earlier years. I think I've answered all the questions. Selva, is that all?
Great.
Yes, sir. Yes, sir. You have answered most questions. Covered everything. Thank you.
Yes, Chairman, sir. You can come on screen.
Yes, sir. Thank you. Thank you, sir. Thank you so much for our great presentation. As usual, the way in which you presented the topic, it shows that your in-depth understanding the subjects. I'm sure this will be very much useful to all the participants of the program. Once again, thank you so much, sir, for your valuable time. Of course, most importantly, my sincere thanks to all the participants for your active participation. Around 400 members at the beginning of the session, around even up to end of the session, the 300 members are attending throughout the session. Of course, though it is a virtual session,
I think we should not keep programs till 9 o'clock. I think by 8 we should close. So we could start a little earlier. It's only a suggestion as a past chairman.
Yes, sir. Yes, sir.
We are on the same page. So members would probably, some of them may be diabetic, they have to have food on time.
Correct. Since the full week, we are having the statewide PDC program for members to discuss about the bank audit allotment. That's why we have started this from 6 o'clock instead of 5 o'clock.
Oh, okay. Today, okay. Yeah.
That's right.
Tomorrow we are having for Kerala.
Initially, we thought that 5 to 6 o'clock we can have for this bank audit meeting. But the bank audit empanelment process, the discussion, I think that also 8 to 8:30 daily, 3 to 3.5 hours is going.
Yeah, a lot of doubts for members. Yeah.
Yes. That's why we have scheduled for 6 o'clock. Maybe tomorrow only we are having 6 o'clock. Day after tomorrow we'll start at 5 o'clock throughout the month.
Yeah, perfect.
Thank you, sir. From SIRC, the great compliments to you for your sincerity and dedication towards the profession. Once again, thank you so much for your continued support to SIRC. Wish you all the best. Thank you, sir. Thank you, sir.
Thank you, everyone. Thank you, everyone. Stay safe, stay determined, stay focused. All the best. Good night.
Thank you.
God bless.
Good night. Thank you, sir. Thank you.